city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg Surveillance, good morning, everyone. John Ferro off this week, a well-deserved week off. I think he went to Staten Island. He said he was going south. Kaylee Lyons in for John Ferro, Lisa Bramwitz, and Tom Keene getting ready for mid-year, getting ready to move on. We need to do a data check quickly. I'm going to make it real quick. Equities up 30. The NASDAQ 100, let me get the percent point on there because that's the way Mr. Ferro would do it.
Yeah,
up 0.9%. The VIX 28.64. Good morning, John. Dow futures up 207 points. We'll leave it at that with yields churning here this morning. As Lisa mentioned, a nudgy tape to say the least. Let's get right to it, and we're going to dive in a little early here on banks. And yes, it's after the stress test, which I guess we're sort of unstressful. And I want to give you a national indicator. We talk about milk. We talk about live cattle. We've got the other prices. Lisa and I whining about it 24/7. Here's what matters. In Southwest Harbor, Maine, there is Beals, which everyone goes to that's ever been north of Portland. Their 90th anniversary, Beals Lobster Pier. And I'm sorry, Gerard Cassidy of RBC Capital Markets, leading citizen of Maine, a lobster roll at Beals is $41.99. Tell me, first of all, about what that does to tourism in Maine.
Well, Tom, those are expensive prices. And for all the lobster lovers out there, that's a steep price to pay for a lobster roll. But believe it or not, the early signs from the state of Maine, the Department of Transportation, we're on a level to break the records for tourism this year. So the prices are not keeping people away. And other than eating 2 or 3 lobster rolls, maybe you only can eat 1.
Yeah, I'll cut it back to 2. That'll work out. Yeah, thank you. $80 to get through lunch. Okay, let us talk about the stress test. Came out glorified. The banks minting money, but they deal with that inflation like Beals Lobster House. How do the banks deal with inflation and cutting costs with cash flow up to their eyeballs?
Tom, it's a really good question because what's very interesting now with the banks is that with these rising interest rates and their asset-sensitive balance sheets, you're seeing the margins widen out quite dramatically. And in fact, if the Fed raises rates again in July, as they're expected to by another 75 basis points, you're likely to see net interest revenue growth this year for many of our largest banks between 15 and 20%. We haven't seen that kind of growth, Tom, in decades. So how they're going to combat the higher inflation is they are getting higher revenue growth through spreads. And you might remember when the margin expands, there's no incremental cost. You're not going out hiring loan officers or opening branches. This goes right to the bottom line. So that's how they're going to combat inflation, as well as keeping a tight rein on expenses as we get into the second half of this year.
So, Gerard, a lot more interest income, potentially a big buffer against losses that we just heard from the Federal Reserve, and the ability to buy back billions of dollars of their shares, as they'll probably announce over the next couple of weeks. Why is the KBW index down 23% year to date, and why do so many people still see this area as a potential for losses?
No, you put your thumb right on it. And the challenge that investors are having today is the tug of war between the better revenue growth, as I just mentioned, from net interest revenue, but offset or partially offset by the rise in cost of credit. And as we remember, following the 2020 pandemic, the banks built up their reserves for massive credit losses that never materialized. And so the bank's balance sheets today are incredibly clean. They're de-risked, but investors remember 2008 and 9, and unfortunately they think that's what could happen in the next recession, which we don't believe at all. We're thinking it's more like 2001 than 2008.
Interesting.
Reason that you mentioned on the downside for banks this year is the fear that the credit will really deteriorate and offset those benefits from higher rates.
Gerard, a lot of this is fear, as you're saying. It might not be reflected in the fundamentals that you're looking at. When do investors start to look for banks to take on more risk? And I don't mean with respect to lending to consumers who are heading into a downturn, but with acquisitions, with using some of the cash that they're using to buy back shares to actually invest in technology that they say is the future.
No, it's interesting because on the M&A front, you are seeing some smaller deals. JP Morgan Chase is the biggest of the banks that are doing these fintech deals, very small deals relative to the size of their balance sheet and capital. But in terms of big bank M&A, that's on the back burner right now because of the changes in the heads of all the regulatory agencies in Washington, new changes coming maybe in rules on M&A. So it's really damped it down. So what they're doing, though, is they're spending on technology, and the banks are, many of the banks are cutting edge on technology like a JP Morgan or Bank of America.
If we could talk about loan growth for a second, because that has been very hard for banks to get back in the post-pandemic area because there was so much fiscal stimulus that people didn't really need to take out loans. Now that borrowing costs are going higher, I'm wondering what your view is on what loan growth is going to look like from here, considering earlier this week, Bloomberg had a scoop that JP Morgan is laying off hundreds of people in its home lending business because of higher rates.
You're right. The residential mortgage business is very cyclical, just like the investment banking business. And because of the rise in rates, many homeowners are not refinancing, and that's really cut into the origination volumes on residential mortgage. However, what we are seeing now is as we move further away from the pandemic, and many Americans have less savings now because they've used their stimulus, credit card receivables finally are now back at 2019 levels. Commercial lending is growing in high single digits. So we are seeing loan growth. Loan growth is tied to nominal GDP growth, and with nominal GDP growth probably coming in this year in the mid to high single digits because of inflation, you're likely to see the banks grow their loan portfolios in the mid to high single digits. And again, it's being led by commercial and consumer.
Well, and as we're beating the drum toward the University of Michigan sentiment numbers later on this morning, Gerard, through your lens of banking analysis, how do you view the health of the American consumer right now?
According to the numbers that we see, and even as evidenced by Bank of America with their chairman and CEO, Brian Moynihan, putting this out last week in Boston, you're seeing the consumer in very good shape. According to the Bank of America numbers, what you're seeing is that in the consumers that had about $1,500 in deposits prior to the pandemic, that Bank of America customer today, the typical customer, has something close to the $5,000. So the consumer, based upon their debt to income, is in good shape, and we anticipate as long as employment stays relatively strong, the consumer is in good shape.
Gerard, in the pandemic and in the digital lift that we all had, digital speeding up, going faster and faster, how threatened, given the pressures the banks face, is the branch system?
Tom, it's really interesting because when you and I obviously had our first real jobs, we got a real paper check You had to deposit, so the branch was extremely important to capture those deposits. That no longer happens, as we all know. So the branch system today is less important than it was 30 years ago. And as you see in the numbers, we're down probably 20% from peak branches back in 2008 when the introduction of the iPhone came on. So I think, Tom, what you're going to see, branches will always be here, but there'll be far fewer of them in the next 20 years.
Fascinating. Al from New Jersey just emailing in saying, tell Cassidy Keene hasn't had a real job in 20 years. Gerard Cassidy, thank you so much with RBC Capital Management, who actually remembers back when I had a real job as well. Lisa, we got to talk about this boom economy. Cassidy just itemized up in Maine. A Beals Lobster Southwest. Lisa, this weekend, the Abramowitz household can have the six-pack pre-cooked lobsters in from Southwest Harbor for $550, $92 per lobster. I'm sorry, Lisa, that's a boom economy under any description.
Except that the Bramo clan cannot have a $550 six-pack of lobster rolls, as much as that does sound delicious. And the distinction between Maine lobster rolls that are cold and Connecticut ones that are warmed, and we could have that debate. This goes to the heart of this question that we have. So far, companies have been able to pass along the costs. People are still buying those lobster rolls.
And
they have
Powell,
been able to jack them up.
I don't mean to interrupt, but Powell said that in his lead sentence this week. He said it's a strong economy, and yet the recession word dominates this week's discussion.
And how much is this a self-fulfilling prophecy? How much are people saying this is what the Fed has to eventually cause in order to bring prices down? And how much is the narrative running ahead of reality? And that's what we're seeing when we look at yields that are coming in, bond prices up, as people expect that perhaps we're already there. We're already in a recession despite the strength. I mean, it's mind-spinning, Tom. It's hard to put this together, especially at a time when you've got companies and the individual analysts saying everything's still really good. We don't know what you're talking about.
You know, email comes in, Kaylee, Margie and Ray's in Virginia Beach, Virginia, saying, would you lose the lobster chat and give us some Virginia crab chat? I mean, from everything you see, Kaylee, it's a boom. For our international audience, we need to say this. It's a crazy boom economy.
Well, that's the thing about it, Tom. And as we talk about UMich sentiment figures coming later this morning, sentiment has been sour for some time, and yet it only is starting to reflect at the margin on activity data. Yes, you had retail sales disappointing, but it's not like things are turning dramatically as sentiment has. I guess the question now is, now that all those savings accounts are drawn down, now that people are turning to leverage once again in order to keep spending, at what point do things turn in a more sharp fashion?
Well, before we all get too happy, I mean, not that I want people to be unhappy, but let's reflect the reality of this going on. If you look at real wages, they're as negative as they've ever been. People's salaries are not keeping pace. They are buying less with the money that they're earning, even as they get raises. So a boom economy, and Tom, this goes directly to a point you've been harping on, which is a boom economy in nominal terms only, not necessarily in inflation-adjusted terms. This is a new boom economy that is a masked, really tepid economy in terms of growth, and that's what sentiment is reflecting.
I would partition folks across deciles, and this is going to be very important and maybe elucidated in the Michigan numbers, where the people up with Gerard Cassidy at Beals Lobster Shack in Southwest Harbor, it is the upper deciles to be sure. But really interesting conversation. Of course, on banking, we'll have that with JP Morgan earnings. I'm guessing third week of July. Futures up 30, NASDAQ up 1% right now. The VIX 28.69, a fractionally weakness. Stay with us after our lobster break. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Actions by the US Senate and the Supreme Court have underscored the deep divisions over gun policy. The Senate voted 65 to 33 to approve gun safety legislation. It calls for improving background checks, securing schools, and giving states money to combat gun violence. The House is also expected to approve the measure. Senate passage came hours after the Supreme Court issued a landmark ruling that would mean more guns on the streets of big cities. 5 Republican members of Congress are said to have contacted the White House after the 2020 election, seeking pardons from President Trump. That's according to video testimony played by the committee investigating the January 6th insurrection. The congressmen included Matt Gaetz, Scott Perry, Andy Biggs, Louis Gohmert, and CFO Mo Brooks. Bloomberg's learned that the U.S. is set to escalate a claim that Mexico violated a free trade agreement. The dispute has to do with Mexican policies that favor state-run energy companies. A dragged-out conflict could lead to the U.S. imposing tariffs on Mexican imports and could increase tensions between the two countries. Wall Street's biggest banks are now set to return tens of billions of dollars to investors. They all passed the Federal Reserve's annual tests of their ability to withstand market turmoil. The stress tests showed that banks such as JP Morgan, Morgan Stanley, and Goldman Sachs could handle a severe recession. And in the UK, consumer confidence dropped to a record low this month. Rising prices, a squeeze on incomes, and disruptions from strikes took a toll on the national mood. The market research firm GfK says its measure of sentiment fell 1 point to -41 in June. That is the lowest reading in the 48 years of the survey. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
it's unconditional, our commitment is. And the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment.
Jerome Powell, on his unconditional focus at 10 a.m. this morning, the University of Michigan 5- and 10-year forward inflation expectations 3.3%. Lisa, it's not a boring Friday. That's a key statistic for the week, for the month, for Chairman Powell to get him to July 27th.
When do people start talking about things getting unmoored, like Bill Ackman was saying?
Yeah.
At what point do we get to an entrenchment in inflation expectations that the Fed has to fight aggressively regardless of how weak the economic data is?
Tina Fordham with us. The Future's up 30 right now. Founder and geopolitical strategist, Fordham Global Foresight joins us right now. We're thrilled to have her on this morning. Tina, I want to digress to the British elections and the uproar of Mr. Dowden, the Conservative Tory party leader, resigning at 5:30 in the morning, London time. And I want to go out far west of London on the way out to Cornwall. And this is not the time of Poldark. This is the time of now. And north of Exeter, Tiverton, in lovely Devon, I hope I'm pronouncing everything correctly, and Boris Johnson was absolutely crushed. What is the symbolism that he was crushed in friendly Devon going back to 1935?
Well, it's another blow to this prime minister who, nevertheless, as you will have seen, Tom, has vowed to carry on exactly as he has been. We've had scandal after scandal. The chairman of the Conservative Party, as you've said, resigned this morning in a sternly worded letter, and yet Boris Johnson doesn't seem to have plans to go anywhere, and that tells you a lot about the times that we're living in. There certainly is no shame in politics, no sense of accountability, and as long as the Labour leader, Keir Starmer, is not a serious challenge, Johnson will probably stay where he is. It's defying the laws of political gravity. By-elections in the UK aren't typically, very, very much participated in. Pollsters will tell you that they're of minor importance. But again, in the face of so many crises that this government is facing, how many times can Boris Johnson get on a plane and go see his friend Zelensky in Kyiv when things are looking tough at home?
Tina, you point to this political gravity or lack thereof that Boris Johnson has, and other leaders may have as well, as we face a lot of individuals who want to be heard about the pain that they are feeling in the face of inflation. And that brings us to some of the strikes and some of the protests that we're seeing erupt throughout Europe, throughout the world. What is the hot spot that you're watching, and what is the consequence, both politically and economically, that will result?
Well, strikes and inflation go hand in hand, and coming out of the pandemic and probably heading into a recession, and with those workers who are on kind of fixed contracts not having seen a pay rise for a very long time, the old summer of discontent term is being bandied about a lot. You guys were talking about the price of lobster rolls. Similarly, I can say that British Airways is threatening, I think, meaningfully here in the UK to start striking as soon as school vacations begin. That's going to be very unpopular, but the question is whether it's going to actually force a compromise in advance. In the UK, this is very acute. France also is known to have strikes, and that will recur. And I guess what I feel is there's a sense of helplessness about this. For so many public sector and other workers, wages have been stagnant through the pandemic, and it's just taking inflation to focus minds.
Tina, we talked about lobster rolls tongue-in-cheek because this is the least of our concerns. It's basic staples, it's wheat, it's basic meat, it's all of these other basic groceries and gas prices that are impeding, as Tom said, the lower deciles. How do we look at possible fiscal spending to offset some of the pressures that are very real, very tangible, and a big threat, particularly to the lower income individuals around the world, in Europe in particular?
Well, of course, the people most acutely affected are the very poorest in EMEA and those who depend on grain supplies that are being blockaded by Russia out of the Black Sea ports. And so that's happening in the Middle East, where there are many concerns, which I've addressed elsewhere, about kind of Arab Spring 2.0 and that sort of thing. In developed countries, we don't get riots or civil unrest in the same kind of way. We get more organized expressions of popular discontent. And that means strikes, of course, and protests. Governments, having responded with so much fiscal largesse during the pandemic, are really going to be expected to step up. And what I think we're already seeing is fuel prices and subsidies for fuel prices are going to come first. Food is a bit more difficult in developed countries, but winter heating, winter fuel allowances, and those kinds of subsidies in the UK and Europe, I think are just a question of when and not if.
Tina, we only have about a minute left, but as we talk about the economic pain so many countries are feeling, are we going to start seeing a dissolution of the resolve of the allies to continue to support Ukraine, inflict economic pain on Russia when it's inflicting so much economic pain on their own domestic populations in return? Are we reaching that breaking point?
We're not there yet, but at the G7 meetings, the measures that are being contemplated, gas rationing in Germany, for example, the question of whether Russia just flat out, cuts gas supplies to Europe as punishment in what a tactic called coercive diplomacy, it's very real. It'll be winter before we see push come to shove on this, but that's why getting the gas storage facilities in Europe filled is crucial. They have to fight this. They can't give in to Russia. I think leaders understand this. Can they communicate to citizens the need to make sacrifices is a bigger question, because politicians don't like to take, they like to give.
Tina Fordham, thank you so much. Greatly appreciate it. With Fordham Global Foresight here on an eclectic set of issues, including stunning election results in Britain. Truly stunning. The historical reach of that back to pre-World War II is really remarkable. Lisa, I've got to touch on this because I mentioned Tunisia, I don't know, 5 days ago, 6 days ago, and I got some emails and love notes saying, why are you mentioning Tunisia? No one cares. Let's remember the Arab Spring. The Arab Spring is happening in Ecuador in the last 24 hours. And Lisa, I'm sorry, it is an end of June where food dynamics, I'll say, and food angst for the poor really click in. And keto, and really, really challenging there. The suit, let's show that right now. If we could, on radio, we're showing the protests in Ecuador. This is a fixed exchange rate, so we can't use currency, Lisa, as a litmus paper for social struggle.
Yeah, but it can be used in other places as well. Bill Dudley pointing to the international concerns as one of the financial stressors that we should look at in addition to the social ones.
We look forward into July and maybe a July and August of food challenges. I look at corn, a bushel of corn stable through the week in America. Futures up 29. Stay with us. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
You actually get inflation under control, especially if a lot of the supply side issues are beyond central banks and policy control.
The only thing you can do is damp demand to try to bring the economy back into equilibrium.
I would not be quick to judge that we're out of the woods when it comes to inflation.
The Fed has somewhat abandoned the specific 2% range target.
Some of the leading indicators are indicating right now we're probably in a slow patch.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday, an important Friday, eventful 6 days from that mid-year point. Kaylee lines in for John Farrow, well-deserved sabbatical for Farrow. I'm unsure. Is he back Monday, Lisa? It's like 50-50, right?
Well, based on where he is vacationing.
Probably his team will say, well, he's on a runway and wherever he is, and he can't get home because of British Airways or, whatever. And
we can look forward to his return. There is an issue of what happened this week, because this was actually a fascinating week. And my biggest question, Tom, is the bond market rally that we have seen this way a good thing or a bad thing for risk assets? What does it mean?
Well, it means to me the 210 spread is the vanilla spread has really not moved all that much. So maybe it's a churn. We'll look at equities with Amy Silverman here. But I'm going to go to the little tea leaves that are out there. Javier Blas, with his leadership on hydrocarbons, nails it. On European coal, Javier just noting 424 per ton. That's the way they spell it. They're T-O-N-N-E. I don't get that.
Really?
Ton.
Really? Is this going to be throughout the morning? It's that kind of day, huh?
It's a little over $100 per ton from where it was during the invasion. This is a serious statistic.
It's a serious statistic because of the plan that Germany has in place, that if they pass a certain threshold in terms of depletion of their hoards of natural gas, they're going to turn to coal. This is a nation that's been trying to make its energy cleaner. And then once it gets past those reserves and they continue to go down, then they start with gas rationing. This, to me, is a political hot potato that's going to have to be discussed in many places if we deal with the same kind of tight supplies.
Le Potage showed, whether it's in France or not, Kaylee, I'm sorry, I can link together Javier Blas and coal in Germany or the Netherlands, wherever that statistic's from, with the riots we just saw, the protests we saw, rather, in Ecuador. I mean, all of these tensions wrap around price change.
Yeah, it's the rising cost of living, Tom, and it's creating quite drastic political unrest in some countries, and it's just reflective in the results of elections in others, like in the UK with those by-election results we saw this morning, where the Conservative Party is taking the heat for the rising cost of living in the UK at the same time that sentiment hit the lowest level on record due to higher prices and the fear of an economic slowdown.
Francine in London emails in and says, Tom, lose the French, you can't speak it. Thank you, Francine. It's good to know that. Did you get that Kaylee Lepotage show? Like
perfect pronunciation.
Very good. Let's do a data check here, and we won't quote in tons. 29 up, 29 on futures. Dow futures up 214. VIX nicely in on the week. This is an important item of good feeling in equities. 28.70 in the equity in the VIX space, I should say. Dollar churning here, but resilient. 104.238. Euro 105.37. Some of the EM currencies still give way, like Thai baht. Lisa, a brief.
Well, the stasis in this week's market is fascinating to me. And I'm not just saying that because there's nothing going on and I need to find something fascinating. It's because we're getting more and more concern being spoken about by Fed Chair Jay Powell, by a growing number of economists, and yet nothing. If anything, there's a rally in bonds and there's a rally in stocks. 10 a.m., do we continue to get that rally with the University of Michigan Sentiment Survey coming out for June 9th through the 20th, considering the fact that it's expected to fall to a new post-2011, 2010 low? How much are we also looking at inflation expectations over the next 5 to 10 years climbing? What happens if we see those climb even further and then bond yields continue to go down? What does that mean in terms of Fed credibility, in terms of what their path is to come, and whether the market is underestimating how aggressive they're going to be? At 4 p.m., we hear from IMF's Kristalina Georgieva speaking on the U.S. economic outlook after she previously spoke with Jerome Powell and Janet Yellen. How much does she signal a weakening in the U.S. outlook based on their previous forecasts, and how that dovetails into, Tom, what you're talking about, the international stress, the international strife stemming from higher prices and a weaker economic backdrop?
I'm so glad you did this with the managing director of the IMF, Lisa. I thought about this last night over a beverage of my choice. Can you imagine the halls of the IMF in Washington right now with Tunisia, Ecuador, EM currencies giving way? I mean, which meeting does she go to next?
And what is her policy recommendation at a time when inflation is at the forefront, yet a stronger dollar only pressures these nations further? And this weekend, we have G7 government leaders gathering in Germany from Sunday through for a 3-day summit ahead of the annual NATO summit in Madrid. How much do they talk about inflation? And again, Tom, what can they do about it other than just simply offset it with fiscal spending and having some sort of supplementary income, as a lot of people think is likely, certainly in Europe?
We'll have to see. You know, I'm sorry, we're just going to have to see how it folds out. And our international team, of course, will give some good perspective on that. I know that Anne-Marie Horton and Maria today are really focused on G7 meetings and the trips of President Biden coming up. Right now, I demanded that we speak with Amy Silverman, writing brilliant notes for RBC Capital Markets, and a hugely controversial note right now on this summer. Amy, you say this summer is different for volatility. Discuss.
Well, look, good morning, guys. I think that normally, you know, you look to history the last 30 years, Tom, and seasonally, this is supposed to be a low time for VIX. This is supposed to be, you know, when people's minds wander to vacations and volumes go lower and, you know, realize volatility comes crashing in. I don't think that's going to be the case, frankly. And I think that you're already starting to see that dichotomy play out in single stocks. So, you know, an ongoing theme in derivatives markets has been, why hasn't volatility been higher? Why has skew not picked up? But you are seeing that in the single names. And I think as earnings swing this time around, we will see an overall level even higher than we do from the levels that are already high right now.
Amy, weigh in on the conundrum in markets right now. Are people underpricing the margin compression that we're going to see in this earnings season, or has it already been baked in?
Yeah, look, it's a tough question. I will tell you that on the broader ETF level, that complacency is there and has been there for a while. But what interests me is that, Lisa, on the single stock side, you're seeing that pickup in demand for downside protection, which tells me idiosyncratically that it is not baked in on many stocks. And this isn't, you know, kind of unique to one sector. It's not just energy or, you know, long duration tech. This is kind of across the board. So it's almost as if people are quickly monetizing those hedges on the index side, obviously, as overall markets go down. But they're still seeing that worry come in on single names. And I think as earnings starts to come into play kind of mid-July, that will become a key theme again. And we will see that is not quite baked in yet.
Amy, this nuance adds to my confusion about the complacency in markets this week. And I keep going back to the question, is the bond market rally that we've seen this week, the retracement in some of the gains that we saw in two-year yields, a good thing or a bad thing for stocks?
Yeah, here's what I'll say. When we look to the options market, there are a lot of bond proxies that you can use to play. So like a TLT, an LQD, HYG, BKLN. I will tell you, Lisa, that there's still a lot of massive hedging going on, especially in BKLN and HYG. So, the way I would think about it is the derivatives market is certainly not saying that everything is warm and rosy, and you're starting to see that tick up not in S&P and IWM, but in these bond proxy ETFs, and that has been the case kind of consistently through the year, even as people quickly monetize. So I think again, as we get into the summer, and I think you're in this kind of like dead zone right now, but as you start to get more information coming in, as we get earnings, as we get through to more CPI numbers, that will start to trickle in again, especially on those bond proxy ETFs.
Amy, really since the start of the pandemic and the boom of meme stock trading, I've been talking to you about retail activity because we know for a very long time they were all in on call options. They always bought the dip. And I noticed some research out of JP Morgan yesterday talking about how that is changing. And actually last week among retail investors, their data showing they reached the heaviest selling since September of 2020. What are you seeing around retail activity?
Yeah, so look, there's a nuance I want to make here because I think when people speak about retail, there's two kinds of retail, right? There's the people who are YOLOing GameStop call options and trading on their Robinhood account. And then there's retail in the PWM sense. So, Tom's portfolio, for instance, what he's doing in his portfolio.
You mean triple leverage all cash?
So a conversation I've been having with Laura Calvasina is, I think that the retail who played the GameStop and the AMC, and maybe crypto has capitulated, and you do see that playing in the derivatives market. But that is not true necessarily of kind of the PWM retail crowd. So, ask yourselves, are you sitting through this market or are you capitulating? Right. And one thing Lori says that I think is interesting is we may not see that because they are trained to ride through these markets. And so you may not actually get a capitulation from that cohort.
Amy, you mentioned 40 on VIX is being the new 30. Are you just essentially predicting we will enjoy a catharsis to 40 on VIX?
I think it's possible. I always like to break it down back to how you feel about that on a daily basis, Tom. So, a 40 VIX is a plus or minus 2.5% move per day compared to 1.89% on a 30 VIX. Do I think we'll get that on earnings? Yeah. Very possibly. I do think VIX is underperformed right now.
Amy, do something constructive over the weekend. I want you to check the kurtosis of my triple leveraged all cash fund. I think, there's some cross moments there in triple leveraged all cash that are really painful. Amy Silverman, they're brilliant as always with RBC Capital Markets. Cash is something worth talking about, Lisa. Seriously, one of the most interesting things we heard this week, Federated Hermes talking about 2 times cash moving from 3% out to a 6% long-only buy-side holding. That's a big deal.
Yeah, your strategy is finally working. My favorite part of the morning is always when guests humor you and you ask them for things and they kind of nod politely and sit there wondering, when do I get to leave here? But this has been an asset class, and we do see flows into cash for the first time in mass.
Yeah, we will have to see. Let me do a data check here. Up 28 on SPX, Dow up 199. The VIX is impressive in a 0.38 points, 28.67. Brent crude 111.51. Please stay with us on radio and television. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Federal Reserve Chair Jerome Powell calls his commitment to curbing inflation unconditional. Powell wrapped up 2 days of testimony on Capitol Hill by warning that the Fed is very far from its inflation target. Meanwhile, Fed Governor Michelle Bowman told bankers in Massachusetts she supports raising interest rates by 75 basis points again next month. It's being called the biggest breakthrough in U.S. gun safety in 3 decades. The Senate voted 65 to 33 to approve bipartisan legislation that will improve background checks, secure schools, and give states money to fight gun violence. The House is also expected to pass the measure. The Senate passed the bill hours after the Supreme Court issued a landmark ruling that could mean more guns on the streets of big cities. In the UK, Prime Minister Boris Johnson has suffered a major election upset. His Conservative Party lost a key parliament seat in southwest England. It's the first time that the constituency, Tiverton and Honiton, is not voted Conservative since it was formed 25 years ago. The Liberal Democrats won the seat. Shares of Twitter are higher in pre-market trade. According to the business site Insider, Twitter sent further user data this week to Elon Musk, who wants to buy the company. The latest data includes real-time information, which allows the Musk team to determine how many users are actually bots. Last week, Musk's lawyers sent Twitter a letter complaining that the data they were being supplied wasn't enough. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I was just talking to the governor of New York about this. I am disappointed in the Supreme Court gun decision. The gun laws in 40 of these states are still in place based on the decision. Not good enough, but it's. I think it's a bad decision. I think it's not reasoned accurately, but I'm disappointed.
The President of the United States on an eventful day for America with not one but two, a legislative and a judicial decision on guns. For those of you in New York, it's simple. Read the crime blotter of the New York Post and you'll get a flavor for what we're living in. Of course, so many of you across the country. Ask Mr. Griffin, his citadel of the path from Chicago to Miami. What we have done at Bloomberg, and this is not just Bloomberg surveillance, but across all of Bloomberg, is get legal authorities that can assist us here on thinking through these very contentious issues. One of those is Noah Feldman of Harvard University. He is a scholar writing of the middle 20th century Supreme Court of James Madison. Feldman scathing on Justice Thomas yesterday. There's no other way to put it. This means concealed carry is now basically an automatic right. This is to wear the weapon out in public. Increasingly, this court appears to be the Thomas court, with the most conservative justice convincing the other conservatives to follow his lifelong practice of ignoring precedent and rejecting the idea that the real-world consequences of judicial decisions should matter to the courts. Emily Wilkins translates in Washington this morning. Emily, let me stay on this judicial decision, as I know Lisa wants to go on other paths. What happens next for concealed carry in America?
So you noted Justice Thomas's opinion on the decision. I would also say that it's important to note what Justice Kavanaugh and Chief Justice John Roberts wrote in on their opinions, because their language was a little bit softer. They said that, you know what, these laws in New York that say you can only have this permit if you've got the certain job or a certain other thing, that's no good, but they can have restrictions on concealed carry. It just needs to be the same restrictions across the board. It'll be very interesting to see how New York Mayor Eric Adams, as well as other mayors of cities where these laws are currently implemented, are going to find ways to cut into that restriction, figure out exactly what cities can or cannot do.
It's not Bloomberg's idea here, Emily, to get into the political ballet, but what does this 6-3 decision signal of the pending cases coming up?
I mean, I think that all of Washington is very aware that we have a much more conservative court. And I think Washington, I mean, the big case that's coming up is Roe versus Wade. We could see something on that as soon as today. Remember, the court actually added today as a decision day. It wasn't initially. It's now been added. Now, it might not come today. It might come next week. But we've heard reports of police officers in D.C. kind of getting ready for potential protests and fallout from that decision today. So we could potentially see it. Obviously, it's being expected that this is going to really cut into Roe v. Wade, that could potentially bring things back to the states. We ask lawmakers, how do you respond to this? What is going to be the next step that Congress can potentially take? The one thing you've heard from them right now is that it really depends on exactly what the ruling says. But let's face it, I mean, Congress has struggled to get through gun legislation. Even the bill that we're seeing today is pretty narrow. The idea that they'd be able to do something more on abortion or even gun legislation, it would be very difficult to do given the current level of partisanship in Congress.
Emily, dovetail these hot button social issues and the court's view on them into the midterm elections and this complicating debate between these social issues versus inflation. What does this do in terms of the Democrats' likely outcome from the midterms and beyond?
Well, I can actually let Senate Republican leader Mitch McConnell answer that one for me. He told reporters yesterday that one of the reasons that he was backing this package of gun proposals was, number one, he thought it was common sense, and number two, he thought that it was important for their midterms, that it's going to help suburban voters see that Republicans do care about this issue, and suburban voters are going to be key in a number of races, both in the House and in the Senate this November. And so there's definitely an election aspect to this.
It will be interesting to see how much things like guns and abortion do drive out voters to the polls. It's certainly midterms, a lot of the game is on turnout. Who can you actually motivate to come out and vote? But on the whole, when you talk to Americans, when you talk to pollsters, when you talk to lawmakers, really the number one issue is still inflation. It's those high prices at the gas pump, those high prices in the grocery store. I think that's why you saw Biden come out and call for that gas tax holiday. I think, though, at this point, there really is not the appetite in Congress to take that up, which, of course, leads to the question, what are they going to do to show the American people that they are taking this issue seriously?
Well, Emily, as we talk about some of these issues related to the Supreme Court, these are hot-button cultural topics. I mean, Second Amendment rights, abortion rights, and we know that where the American public opinion is based on a polling data, research data, isn't necessarily aligned with decisions the court is making, or at least according to draft opinion, seems that they're ready to make. Is there any more conversation in Washington about reforms to the court? I know when the president came into office, there was a conversation about court packing.
There was, and I think like so many other issues, there are simply just not the votes right now to be able to do something like that. Even for some Democrats, I mean, that would be a little bit far to try to add additional justices to the Supreme Court. There's certainly a couple bills in the works looking at the ethics of judges, both in the Supreme Court and across the federal system, but that is sort of taken a sideline to other legislation that we're seeing go through right now. I mean, these are definitely hot button issues, but we're at the point where we just have a Congress that isn't moving forward on a number of these things because of the partisan gridlock. And even though you see these surveys that show that Americans really do support a number of these issues, that doesn't always translate into how they vote. And that's why you're seeing the Congress as it currently is right now.
Emily Wilkins, thank you so much. Greatly appreciated in Washington, particularly there on Noah Feldman's piece for Bloomberg Opinion as well. Lisa, to be kind, it will be a contentious summer in Washington.
Yeah, especially with the court decisions that are likely to come down and going beyond people's expectations of how far the court could go. What we just heard, though, from Emily was fascinating, that in the Republican Party, there is more willingness to go further on the legislative front to stave off some of the galvanizing effect socially for Democrats to go to the polls, to basically ease some of the blow. How much does that start to get something done in some bipartisan way?
I'm not making a formal study of this, but loosely, I'm looking at elections around the world. And the power of the ballot box is extraordinary. Witness in England today. Lisa, the size of this defeat of 3 small elections for the prime minister is just extraordinary.
And will the presiding issue in the United States be inflation, right? Will it just remain that way, even with some of these social issues really percolating into the conversation in a massive way throughout the summer?
Okay, that can be the question, and it sounds like George Bush Sr., but Kayleigh Lyons, I think you nailed it. It's a culture war. I mean, that's really what we're talking about.
That's the place we're at in America right now, Tom.
Yeah. We'll have more on this, and again, I really urge you to see the legal coverage of Bloomberg Opinion. It's truly extraordinary and informed some of the great academics of this nation on the right and on the left as well. Coming up, we're thrilled to bring you Yana Hatzius of Goldman Sachs.
has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg Surveillance. Good morning, everyone. John Farrell, well-deserved week off. Kaylee Lines in with Lisa Abramowitz and Tom Keene. Thrilled you're with us on radio and television. Sterling right now, 122.80 flat off of the shock of those three small elections in England, all against Prime Minister Johnson's future. Futures in the U.S. up 32, advancing nicely. NASDAQ 100 up 1%. Because Dr. Hatsius is with us, we'll go quickly here. Lisa, individual stocks.
Yeah, I'm looking at a number of earnings that came out, in particular FedEx yesterday after the bell, that really were much better than expected. FedEx shares up nearly 3% ahead of the open. Tom, fascinating to see why. They're actually seeing some of the labor shortages ease. They're seeing profit margins come in a little bit better than expected, kind of going against the gloom narrative that we've been talking about. Shopify bouncing a bit after rolling out some new features, but those shares down more than 70% so far this year. And Twitter shares getting a pop, although off earlier highs after reporting that they are going to give Elon Musk whatever he wants to see in terms of data over the weekend, and Elon Musk trying to back out of the price tag that he had by asking for more. That's my interpretation, because it is going to be interpretation Friday. Looking at the banks this morning, given the fact that they're going to be rolling out buyback plans after those stress tests, interesting to me that Citi is not participating. How much has been already baked in? JP Morgan Chase up 0.4%, Bank of America up also a similar amount. Tom, how much can these banks really reprise some of their value in the shares, given the fact that they're down more than 20% as a wholesale so far year to date, and they still have billions of dollars of expected share buybacks coming?
Lisa, thank you so much. From Dudley and McKelvey to the era of Hatsius, Goldman Sachs research has been about acuity. On this Friday, we're going to lose the numbers, the many numbers of Jan Hatsius's work, his team's work, but we're going to go to one number, which is your Q4 number. They've marked down GDP from a sterling 1.3% to sub 1%. That gives you some of the direction of the recession call, but at the same time, Jan Hatsius calls for a shallow recession. If we get a shallow recession, you quantify what it will mean for jobs in America. How does the magnitude of recession work into the dynamics of unemployment?
Yeah, let's just be clear that we don't have a recession in our baseline forecast. We do have significantly below trend growth. 0.9% is only half the long-term trend pace. But our best guess is that we'll be below trend. That rebalances the imbalance in the labor market, and that ultimately also helps bring inflation back down. That said, there's a very significant risk of recession. I think it has gone up because it's very difficult to reduce labor demand without, the deterioration feeding on itself and then ultimately culminating in a recession. So we're giving a 1 in 3 chance of a recession in the next 12 months, and it's cllose to 50-50, I think, over the next.
But you've
over the
got
next
2% of unemployment rate baked into a 2001-ish kind of recession.
In 2001, it was a 2 percentage point increase. That was the bottom end of the historical range. If you look at all of the recessions in post-war history, the top end of the range is 5.5 percentage points. I think if we do have a recession, it's likely that it would be on the shallower end for 2 reasons. One, private sector balance sheets are in better shape than at the end of previous business cycles. And 2, I think, while inflation is very high, I don't think it's as entrenched, certainly not as entrenched in expectations as it was in previous high inflation episodes, 70s, early 80s.
Jan, we just got off a couple weeks where people were ratcheting up their expectations for the terminal Fed funds rate to about 4% as of at some point next year. And here we are looking at a huge rally in 2-year yields. Can you translate the rally that we have seen through an economics lens in terms of what people are forecasting and whether it seems plausible in your mind?
Well, our forecast is a terminal rate of 3.25% to 3.5%. We think we'll get there by the end of 2022. We don't have any additional rate hikes in 2023, basically because the economy is decelerating, is growing below trend, inflation is coming down, and I think at that level the Fed would probably hold. You're right, we had priced something around 4%, immediately after the FOMC meeting or right around the FOMC meeting. But I think people have looked at the fact that the economy actually is decelerating, and that has led to a reversal of that. And I think fundamentally that's appropriate.
But Jan, given the fact that we are seeing a deceleration, but we're not seeing a deceleration when it comes to the inputs into inflation. We're seeing rents continue to climb at a record pace. We're continuing to see some of the disruptions to oil supplies and to food supplies that are causing some of the price increases. When do you start to talk stagflation? When do you start to talk about a Fed that is forced to act despite an unemployment rate that's rising and despite weakening economic data points?
Well, I think it's a little bit more mixed if I look at the inflation indicators. No question, the last CPI and the rent number there was bad. There was an increase in the long-term University of Michigan inflation expectations measure, but the supply chain measures are actually getting better. You look at the supply delivery indices in the business surveys, those are coming down. The wage numbers in 2022 have been sequentially clearly slower than the second half of last year. And I think broadly speaking, inflation expectations, look at just the break-evens in the bond market, are still very well anchored. So I think it's a more mixed picture. And in an environment where growth comes down to a below-trend pace, I just don't think that the Fed would keep hiking aggressively when the economy is already slowing and inflation is already coming down.
So, Jan, essentially what you're saying is that when Chairman Powell was speaking on Capitol Hill yesterday saying that our commitment to fighting inflation is unconditional, that there actually are conditions in which the Fed blinks.
I think there are conditions where the Fed blinks, but it's partly because there's a feedback from economic activity into inflation. If the economy weakens and labor demand declines and maybe the unemployment rate starts edging up, then you're also just going to become less concerned about inflation. So I do think the commitment to ultimately getting back down to 2% is unconditional, but there will be factors other than the current inflation prints that will sort of drive what they do on a meeting-by-meeting basis.
While we're talking about the specific words that Jerome Powell has used, I've talked earlier in the show about the tweets Bill Ackman posted overnight talking about how the Fed clearly has a credibility problem. The bond market is misreading the Federal Reserve, and what he said is ultimately that comes down to the communication of the chairman. Do you think that Powell and others on the FOMC are accurately communicating to this market what it is they intend to do?
No, I think they are accurately communicating, I think, in ways that are clear, that they do want to get back down to 2% eventually. They're tightening policy aggressively, much more aggressively than they expected to do 6 months ago or 12 months ago, in part because inflation turned out to be much higher. So I think at that level, it's all pretty clear. On the credibility problem, I would also say, look at inflation break-evens. I mean, the credibility from the bond market's perspective or from the perspective of forecasters of the 2% inflation target, still seems intact.
Yeah, and I want to go to Peter Orszag of the London School of Economics in a small banking shop in New York. Peter Orszag loves the phrase glide path. And maybe that's differential equations, but it's Friday. Let's just stay with calculus. Are we completely misjudging the second and first derivative of core inflation coming in where it may come in shockingly rapidly, and we underestimate that good news?
I do think that core inflation is likely to come down. In fact, if you look at statistical measures of core inflation, like the trimmed mean index,
Cleveland,
that
Dallas,
has been improving over the last few months. It's still a little too early to tell how much weight to put on it. But the last couple of readings have been more encouraging, and I think that does suggest that over time, core inflation is going to come down. And we're at about 4% for core PCE, core in this case defined as ex-food and energy, by the end of the year, and then at about 2.5% by the end of next year. So I don't think it's going to happen overnight, but I think we're headed in that direction.
So when Jerome Powell says we get back to 2% inflation, that's what he's talking about. And Hatzius says Powell will get his wish in 18 months.
Not quite. We're at 2.5, but that's not too far away from
TV,
2%.
John, 2 and 2.5. It's TV. Who's counting?
Especially if you look at this as an average inflation target. Okay, so at some point there will, whether there's a recession next year or not, our best guess is not, but there will be a recession at some point, and that will bring inflation down further.
I should say with great respect, I'm busting Dr. Hatzius' chops. There is a huge difference between 2 and 2.5% in the inflation game. Jan Hatzius is with Goldman Sachs. Thank you so much for coming in. And quickly, with the headline there, Lisa, no question about it, was shallow recession. This magnitude of recession until this week, Lisa's really been underplayed amid the doom and gloom that's out there.
Shallow recession, and the other interesting thing that Jan was talking about is that the Fed is not going to be as aggressive as people are currently pricing in, and that is what you're seeing reflected in the bond market today, considering that the 3.25% terminal rate that he's forecasting is well below the 4%.
Well, are you saying Hatzius just moved the bond market? Is that what you're saying?
No, I'm not saying
I'm
that.
I'm looking at 4 beeps up on the 2-year yield. I think Hatzius just moved the 2-year yield.
Okay, you go do that. You put the narrative to that. I'm actually looking at the point of credibility also, and if you look at some of those futures, if you take a look at break-even rates, they're close to that 2% level over the next 5 to 10 years for the Federal Reserve. So kind of seems to support, even with a less aggressive Fed, they'll get back there.
But at least, Kaylee, I should say, still, Kaylee, it is about headline inflation for so much of America. It's still a really ugly statistic.
And the chairman himself spoke to that what Americans feel at the end of the day is the gas and the grocery bills that they are now facing. And to Lisa's point about, okay, the Fed has credibility on getting inflation down, is it so much the confidence in their ability to do that, or at what cost? And that's also what's reflected in the fact that yields, nominal yields, are coming lower because of concern around a recession, even if it's shallow, as Jan Hatzius indicated.
Futures up 29, the NASDAQ up 0.9%. Hatzius moves the yield market 3.05% on the 2-year yield. Please stay with us. Maybe Jan Hatzius will come back again. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Actions by the U.S. Senate and the Supreme Court have underscored the deep divisions over gun policy. The Senate voted 65 to 33 to approve gun safety legislation. It calls for improving background checks, securing schools, and giving states money to combat gun violence. The House is also expected to approve the measure. Senate passage came hours after the Supreme Court issued a landmark ruling that could mean more guns on the streets of big cities. 5 Republican members of Congress are said to have contacted the White House after the 2020 election, seeking pardons from President Trump. That's according to video testimony played by the committee investigating the January 6th insurrection. The congressmen included Matt Gaetz, Scott Perry, Andy Biggs, Louis Gohmert, and Mo Brooks. Wall Street's biggest banks are now set to return tens of billions of dollars to investors. They all passed the Federal Reserve's annual test of their ability to withstand market turmoil. The stress test shows that banks such as JP Morgan, Morgan Stanley, and Goldman Sachs could handle a severe recession. And in the UK, consumers are starting to crumple in the face of soaring prices. The government says the volume of goods sold in stores and online fell 0.5% in May. The big jump in food prices forced consumers to cut back on spending in supermarkets. Meanwhile, another report says consumer confidence in the UK has fallen to a record low this month. The former chief operating officer of SoftBank, Marcello Claure, has received severance and incentives worth an estimated $94 million as part of his compensation. He left SoftBank in January. He had clashed over compensation with the company's founder, Masayoshi Son. Global News 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Inflation is a huge challenge right now. We know this. It's driven by two primary terrible policy approaches from Washington. We gave up our advantage in energy, and we actually took an anti-U.S. production approach. Job one, I believe, is to have a pro-all-of-the-above energy policy, which includes promoting domestic production to recapture this domestic production advantage.
The governor of Virginia, Glenn Youngkin, there with David Weston, Balance of Power. Great to greet the governor yesterday here at our world headquarters. He's concerned about inflation in his Virginia. Right now over in Europe, there's a UBS conference in Zurich, and someone else concerned about inflation is a gentleman from St. Louis. This is James Bullard of St. Louis, and with him is Philip Lowe of Australia, the RBA, who studied under Krugman at MIT, and Luis de Guindos of the ECB as well. And Bullard making headlines. Lisa, help me here with the headlines from Bullard.
Yeah.
He is more optimistic than the average bear.
Yeah, talking about how the U.S. economy has shown tremendous resilience, and then pointing to household balance sheets and households in general not seeing signs of a pullback. Is this a good thing or a bad thing for a Fed that needs to get inflation under control at a time when people are accepting higher prices and still buying?
And I'm going to say he's on the edge of Jan Hatzius here, where Hatzius and Goldman Sachs not calling for recession. I think is Bullard the most optimistic horse around the Eccles table?
I don't want to go that far. The issue is, what do they do with that? If we have a lot of momentum and strength now, how does that translate out 6 months from now in terms of what the Fed will have to do and where the economic indicators are pointing at that time?
In agreement with James Bullard to a great extent is a gentleman with Boston Advisors for years. We are thrilled to bring you right now Michael Vogelzang. Michael Vogelzang, of course, has done so much in economics, and we're thrilled he could join us from Cap Trust this morning. Michael, it dovetails with your view, which is lose the gloom on a Friday, get out front by acquiring fixed income for a higher price and lower yield. What fixed income do you acquire?
Well, look, I think the fixed income market's reasonably well balanced here. I don't think, given where we are with sort of the known impacts of inflation and the somewhat uncertain trajectory of the economy, whether we have a recession or not, it's certainly likely to be 23 if we do. We think longer term fixed income is a reasonable hedge against increased equities. That's really the dynamic here, Tom, is that we've been adding to our equity positions, given we think risks are reasonably balanced. We're down 20+%, 30% on the average stock in the U.S. So we think actually now is a decent time to begin tiptoeing back into equity markets for long-term investors. But we like to hedge that in case the economy does get really weak with longer duration assets. We've been very short all year. Now we're starting to extend. Does that make sense?
Mike, it does make sense, and it's revenge of the 60-40 portfolio, and that's what we've seen this week. I mean, basically people going into both. How long can that continue?
Yeah, I think, that is the $64 question, of course. We're interested in trying to understand what risks are in the market and what aren't. One of our favorite phrases at the firm, at Cap Trust, is the price is the only thing we know. Everything else is speculation and conjecture. And we know that prices on bonds are up from, look at the 2-year. It's up from 20, 30 basis points at the beginning of the year up to 3%. Same thing in the equity markets. We're down substantially. Again, we feel that gives us a pretty good insight into what risks are out there. The risks are now finally being recognized in the equity markets particularly. And yeah, we may be early. There's another phrase I love is, you probably heard this, is pessimists sound smart, but optimists make money. We're definitely trying to be in the latter camp.
Mike, how much are you looking at the consensus soft landing and in the optimists making money, even if the pessimists, talking about a very deep recession, sound smart?
It's a really difficult decision. I do think that in order, and it's frankly, it's out of the Fed's control. You heard Powell the last couple of times he's talk about the things that he can control, right? But he can't control what happens in Russia and Ukraine. He can't control what happens to the long-term price of oil around the globe. This food shortage and the higher prices of food and some of the other metals, some of the extraction industry prices that are so expensive, he can't control those things except at the margin, right? He can control housing. And that is very clearly something we're watching as housing goes. And we're starting to see some of the cracks in the foundation of this incredibly hot housing market. So we think that's going to be a really good, important tell as we go forward. So, if the Fed gets a break on oil prices, the Fed gets a break on food and some of the geopolitical stress that's out there, we think actually they can find a path to a reasonable soft landing, like Bullard, like Jan was saying. If we get a little lucky, if he doesn't, it could be more of a difficult time.
Okay, so given there is still a question around that, and right now you are seeing yields moving lower, you think there may be some value there. What within equities are you buying, value or growth? Or is it more nuanced than that?
Yeah, it's you know, as we've sort of dug through the detritus of the crash over the last 3 months, you know, it's actually hard to find anything that's screaming at us. I sent along a chart that shows the percentage of stocks in the Russell 2000, or the number of stocks in the Russell 3000, I'm sorry, the broad market, that are trading at less than 10 times earnings. And that number is over 515, I think, as of the other day. And every time we've reached that level, and we've reached it, you know, a handful of times over the last decade, what you've started to see is really good returns going forward. So 1 year out, pretty good numbers, and 2 years out particularly. So we're starting to get into the territory where segments of the market are cheap. And to me, those are things like, that's housing, that's energy, that's some of the retailers. I think what that part of my portfolio looks like is, and what it's there for, is kind of a hedge against the Fed being right. That the Fed wins the game and does a soft landing, and earnings don't crater, because what those stocks are estimating and expecting is that earnings will fall substantially. So if the Fed's right and earnings actually come through for some of these inexpensive, more cyclical companies, you're going to see some really good returns out of those. I do think, by the way, it is time to begin to look at the growth side, or particularly the mega cap side of the market. Some of these names are actually inexpensive. They're on a relative basis, they're almost as inexpensive as they've been in 5, 6, 7 years on a price to sales basis and so on. And I'm talking about all the big names that you all know and love. So they've had a real drawdown, but there's no clear and obvious, you know, what we like to call the burning building, where you run in and you're getting paid to take a big chunk of risk. There's really nothing like that. The market's reasonably well balanced.
Michael, thank you so much. Michael Vogelzang with us with Cap Trust here. Lisa, I'm sorry, there's been way too much optimism in the last 20 minutes. Help me out here with some Brammo gloom. The Brammo can, the lens almost broke there with Vogelzang.
No, look, he very well could be right, and he's really representing what's increasingly the consensus. That a soft landing looks possible and actually likely, as long as there is some cooperation with the international sphere. I just keep going back to what it is saying that the bond market is rallying, and have stocks fully priced in the slowdown necessary to justify some of the levels that we're seeing in the yield market.
We'll have to see. It's an interesting hour, an interesting day in foreign exchange. We'll tease you with that in the next hour as well. Futures up 26. Dow futures up 201. Good morning to John Farrell. Maybe back on Monday. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale, as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed will be able to slow demand sufficiently to bring demand down.
The Fed is changing their policy narrative so quickly.
The Fed is solely focused on inflation.
I think the market oscillates between inflation concerns to now recession concerns.
I think Powell is trying to finesse it. He can't go wobbly on the resolution to tackle inflation right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Looking forward to an all-important consumer sentiment reading. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, John Farrow, and Lisa Abramowitz. John off today, back next week. Kaylee Lyons with us, which we're very glad about. Tom, how fragile is the calm in the face of the data that we're going to get today at 10 a.m.?
Well, the data at 10 a.m. is absolutely critical. So says Jerome Powell, folks. This is looking out 5 years, and then the guesstimate from 5 years out, another 5 years. And it is a question of, is inflation finally anchored as it's been for decades, or is it unanchored? And that sort of squishy concept, Lisa, what it means is a lot of uncertainty within the markets. We've certainly heard that this morning.
Uncertainty is the word of the year, and frankly, the word of the moment, especially in light of the fact that we hear this optimism from Jim Bullard to Jan Hatzius about earnings, about consumers, about the strength of the U.S. economy, in light of a rally into bonds, Tom, that indicates perhaps slowing growth and something more recessionary. Try putting those two ideas together. Well, I'm struggling.
You know, to me, Lisa, it's really important, and this is about resiliency. Jan Hatzius and Goldman Sachs are looking for a tepid American economy in Q4, well under 1% GDP. What he's suggesting is the system is in place, including the balance sheet of individuals, households, of businesses, where we can maybe have a shallow recession, which is that resiliency that Bullard leads with.
And meanwhile, Kelly, we are looking at perhaps the first week in 4 of gains for U.S. equity markets, but they're not that broad-based when it comes to looking under the hood and still indicate a bit of caution.
Yeah, shifting into defensive areas of the market like healthcare and technology as well, which has actually benefited from the fact that yields are actually moving lower, whereas the higher movement in yields for so much of this year has put pressure on some of those high multiple stocks. But as you say, Lisa, it is so nascent. We're still talking about a technology sector, the NASDAQ 100 index, that is down the better part of 30% on the year. So how much does 1 week make?
And Tom, when you talk about 40 on the VIX, you've been talking about it for a couple of weeks now. When do we get the catharsis? When do we get the washout? And Amy Wu Silverman, I thought, was brilliant, talking about how in individual names you're starting to see an increasing amount of hedging activity. At what point does the calm get broken in the face of a VIX that still hasn't moved to the degree that you've been waiting for?
Yeah, the VIX right now, 28.77, which is very comforting over the length of the week. Let's call it from 32 to 29. 40 is distant. And again, this goes, and we've heard this from any number of guests, that flows. The tone that's out there is optimistic. Gerard Cassidy of RBC Capital Markets, I believe on the West Coast this week, said, you know, the tone was pretty good.
Yeah, and the tone is pretty good in markets, although off a little bit earlier highs. We're looking at about 0.7% gain for the NASDAQ and the S&P, both the same, 38.27 on S&P futures. The bid into bonds fading a bit. We are seeing yields higher, price down 3.12% on the 10-year. 2-year similar move, although as Tom, you described it earlier as churn. I think that that's very well put. And crude, this to me is interesting. We saw a flip yesterday after crude had sold off in light of some of the recession worries, and it got a bid. This sort of push-pull between supply and demand and this idea of what could potentially be coming down the pike when it comes to a downturn. Right now, I really do think that the question at the moment is whether the bond market rally that we have seen this week is a good thing or a bad thing for stocks. Have we seen a revenge of the 60-40 portfolio that has some sort of persistency to it that people hadn't been seeing for the bulk of this year so far? Michael Bell, global market strategist at JP Morgan Asset Management, joining us here. Michael, what's your view on that? Do you think we're going to see a persistency to the rally, or at least the relationship between bonds and stocks from here on out?
I certainly think that bonds have become a lot more attractive than they were. I mean, my simple point is that the housing market can't really handle 30-year mortgage rates going up much more than they have already. So to me, that suggests that we're probably nearing the peak for bond yields. It's not to say they couldn't go a little bit higher, but I think if bond yields were to move materially higher than where they are at the moment, and that fed through into even higher mortgage rates, then I think that's going to cause problems for the housing market. And that kind of caps out how high bond yields can go in my mind.
Michael Bell, within the fractious debate of JP Morgan, and it's a wonderful debate, compare and contrast, for example, housing in your England from housing in America. Do you people combine them together, or are they truly distinct?
I think they are quite different, because in the US, you've got 95% of people on relatively long-term fixed-rate mortgages, whereas in the UK, about 17% of people are on tracker mortgages, and about a third of all the fixed-rate mortgages are fixed for 2 years or less. So the UK is going to feel the increase in interest rates much, much more quickly than the US would. However, the US isn't completely immune to higher interest rates just because 95% of people are fixed. It means that the vast majority of people aren't even going to notice interest rates going up. But who does notice? Of course, the people who notice are those who are moving homes. And for them, the 30-year mortgage rate's gone from sub-3 to about 5.75 today. At those kind of levels, if you look at the cost of buying a house, and bear in mind, house prices have gone up about 40% since the end of 2019 in the US, the amount that it would cost the average household as a percentage of their income to buy the average house today has approximately doubled over the last couple of years. So that's why I think that even though the US is much more resilient in terms of most people not feeling those higher rates, housing transactions will come under pressure, and already are starting to come under pressure because of these high rates. And for me, that's what caps out how high bond yields can go.
Yeah, you won't find me house hunting anytime soon, Mike. I can tell you that much. As you talk about the capping of how high bond yields go, does that also form a bottom for the equity market? How close are we to that?
Well, I think it depends really ultimately on whether we end up getting a recession or not, because I think you've seen valuations come down a long way. And valuations now, with the exception of some of the growth stocks in the US, which are still trading on a P of about 21, which is really remarkably high given how fast stocks have fallen already so far this year. But the value sector of the market trading on a P of about 13 in the US and equities outside of the US, which are generally trading on Ps of somewhere like 10 to 12, valuations look pretty reasonable. So the big question now is, given analysts are still forecasting that earnings are going to grow this year and next, is that too optimistic in the face of a potential recession? If we get a recession, then I think potentially there's a bit further downside as analysts' earnings expectations need to come down. But I would say, you know, with markets down as much as they are year to date, it's going to be hard to sell at these levels and then buy back in cheaper. You've really got to have a high degree of confidence that you can time the bottom if you think you're going to be able to do that. So I think it makes sense to be pretty neutral on risk assets at the moment, given all of that.
Michael, it is now time in the week where we talk about feelings ahead of the consumer sentiment read from the University of Michigan. And after the feelings, they're represented by the consumer sentiment in the United Kingdom, which came in at the weakest, the worst going back half a century. Is there a lack of cohesion right now between the feelings and the fundamentals in the equity market?
Well, obviously, if you look around the world, both Michigan survey in the US, consumer confidence here in the UK, and indeed in Europe, you've got basically near record lows on consumer confidence. That's because consumers are feeling the squeeze from higher prices, and add into that, they're facing the fact that interest rates are going up as well. Now, is that out of line with what the markets are pricing? Not particularly. Just look at the share price of retailers, for example, that have been absolutely hammered across the world. But I think that the market's not completely unaware of this risk that you're going to get a pullback in consumer spending. The question is just how much further has that got to go and whether we end up in recession or not.
Michael Bell, thank you so much. Greatly appreciate it. JP Morgan Asset Management. Moments ago, the first read of the weekend, there's no other way to put this, our wonderful David Pan with a topic literally at the top of my reading pile this weekend, which is mining and Bitcoin and crypto. Kaylee Lines, almost $4 billion in Bitcoin miner loans are coming under stress. This harkens to Raphael Auer of the Bank of International Settlements.
Well, it really speaks to the liquidity issue that the entire crypto complex is facing. But for these miners, well, many of them have piled on the debt. They are now in serious crisis, as we've seen prices for cryptocurrencies come down to the point where they are now having to offload some of their stake in these coins, actually selling Bitcoin and some of their mined reserves in order to be able to provide enough liquidity to continue operations. And I would note for the miners, Tom, a lot of it also comes back to the inflation story and to higher energy prices story, because it costs a lot to keep these mines in operation. They consume a lot of energy.
Lisa, I got to go to Kaylee on this. I mean, we're talking thermodynamics here, and you killed that at UVA years ago.
Oh, yeah.
Kaylee Lines, what is a crypto miner?
Basically, a crypto miner in a proof of work system is how you get the transactions in cryptocurrency. Someone has to do a bunch of complicated math on a computer in order to make it work. Now, there is movement, especially on the Ethereum blockchain, to moving toward proof of stake, in which that process is a lot less complicated. Basically, you just have to put up your own stake in order to process a transaction. And in theory, Tom, that makes the whole thing more energy efficient. Though that upgrade to Ethereum, that would put it to proof of stake, keeps getting pushed further and further out. So there's a question of whether or not we get it. Was that really wonky?
Yeah, it was very wonky.
Felt like I
would just suggest T-Bone or New York Strip. I don't know which. Lisa, right there was a clinic on my skepticism is all. Folks, I'll be blunt. Read David Pan at Bloomberg. It is a brilliant story on mining. Read Raphael Auer at the Bank of International Settlements. I don't know what to say about that. It's brilliant. Futures up 30. This is Bitcoin. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It's being called the biggest breakthrough in U.S. gun safety in 3 decades. The Senate voted 65 to 33 to approve bipartisan legislation that will improve background checks, secure schools, and give states money to fight gun violence. The House is also expected to pass the measure. The Senate passed the bill hours after the Supreme Court issued a landmark ruling that could mean more guns on the streets of big cities. In the UK, Prime Minister Boris Johnson has suffered a major election upset. His Conservative Party lost a key Parliament seat in southwest England. It's the first time that the constituency, Tiverton and Honiton, has not voted Conservative since it was formed 25 years ago. The Liberal Democrats won the seat. Crop prices have crashed back to where they were at the start of the war in Ukraine. That potentially could bring some relief to food inflation that is squeezing consumers. Wheat, soybean, oil, and sugar are amongst farm commodities that have retreated in recent weeks. The Bloomberg Agriculture Spot sub-index is on track for its worst week since 2011. And shares of Twitter are higher in pre-market trade, according to the business site Insider. Twitter sent further user data this week to Elon Musk, who wants to buy the company. The latest data includes real-time information, which allows Musk's team to determine how many users are actually bots. Last week, Musk's lawyers sent Twitter a letter complaining that the data that they were being supplied just wasn't enough. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Yes, we can. The changes that we're seeing taking place in economic performance are to be expected. All of these changes were acknowledged by risks by ministers, by the Commission, by the ECB. So it is a risk, but yes, we can avoid it.
Pascal Donahoe, the Eurogroup president there, speaking on the issues at hand, meetings this weekend, of course, in Europe. We've got to squeeze this in. It's too important. Lisa Abramowitz, Bullard of St. Louis in Europe with UBS, I think in Zurich, looking for a 3.5% Fed funds rate. Tips show market pricing in 3.5 Fed fund. That's a big deal, Lisa. I'm sorry. That's optimism.
And this is the coming away from that 4% Fed funds rate that some people were looking for, and that we heard Andrew Hollenhorst of Citigroup reiterate yesterday. How much do we see people easing off their expectations for how far the Fed will have to go?
2-year yield yanks back from under 3%, 3.08%, up 7 basis points. 10-year yield 3.11%. Dollar quiescent all in all this morning. This is an immense joy right now. Shahab Jalanous is global head of FX strategy at Credit Suisse and joins us this morning. And I want to go to the magnitude of your calls. I want to go weak yen well out past 140. And Swiss franc, we've been watching the last 20 minutes to see if we go through parity. Strong euro Swissy coming down nicely under parity, and you say goes further. Why do we get these magnitude of moves in foreign exchange?
Well, we're seeing the end of the former system of central banks using balance sheets to essentially manipulate where FX rates trade. And as that system frees up or comes under pressure, you're seeing FX rates react to that. In Switzerland, they're much further ahead than where Japan is right now in making that transition. Japan is trying to stay the course as long as possible. So that's what we're seeing reflected in FX.
So are you calling for a Bretton Woods moment? I mean, is it a big enough shift coming off of balance sheet dynamics that it's a la after World War II and what Keynes and the others did at Mount Washington?
It doesn't need to be as big as that to still have very significant effects for FX investors. Let's put it that way. So, for example, in the Euro-Swiss cross, it's very easy for us to imagine that cross going down to 97, even lower in the weeks to come.
What does it do to a McDonald's hamburger and a Bahnstoff just down from the Credit Suisse office asking for a friend?
Yeah, it's a good idea to think about those things. I guess they will get more expensive, but that's not something that is worrying the S&B at this point. So,
Lisa, that top ticks out at $20 for a number 2 value meal.
I'm sure that there is some personal experience wrapped in there. I can't figure it out, but I think that's my hunch. Shahab, I wonder how much you're looking at peak yields, as we were just hearing from Mike Bell of JP Morgan, and how much does that mean peak dollar, right? How much are these two measures really trading in tandem?
Well, look, it's definitely been the case that rate differentials and the US's much higher yields have been helpful for the dollar. But to be honest, I think there's more to the dollar story than just yields. For example, on the trade side, there's been very big shifts in trade dynamics that really need to be recognized. So, for example, right now we have the euro area with a trade deficit. We have Japan moving rapidly in the same direction as well. So currencies like the euro and the yen that historically were backed by trade surpluses, current account surpluses, the whole energy price shift and the terms of trade shift has really changed that dynamic materially. And meanwhile, on the US side, you have record exports at this point. There's going to be nearly $200 billion of just agricultural exports in this fiscal year, according to projections from that side of the story. So when you put all that together, to me, there's more to the dollar strength story than just rate differentials at this point.
This is a really important point. How does this translate into some of the big crosses, whether it's euro parity or just in general, how strong the dollar can get?
Well, I think the dollar right now looks strong compared to the last 3 to 5 years, that's for sure. But I think if you go back much further, the dollar has been a lot stronger for a variety of reasons. And the key point I would make is it's not the same dollar as the last time euro dollar was at 105. You know, when you have euro now with trade deficits as a problem, you basically need capital inflows into the euro area on a net basis if you're going to have a current account deficit. And that's something that has been missing. The euro has been a capital exporter for many, many years. So there's a new value proposition that the euro needs to offer at this point in time, simply to avoid going down. And I think that's absent right now.
Well, let's move from Europe to the island just next to it. We had UK consumer confidence data earlier today showing a record low, the lowest in 48 years of data, clearer concern around inflation, the cost of living, the possibility of a recession. How does that feed through to your view on sterling?
We think sterling is still going to go lower. We are looking for a test of 120 on cable again, and eventually a move through that level. The problem for sterling, really, you still have that same trade story developing that I mentioned for the euro area in Japan. It's not like years of a weak pound have created big trade surpluses or very competitive UK exports. That just hasn't happened for a variety of reasons. And so you have a currency that doesn't really have any reason to go up right now. Even when you think about the Bank of England, the market is pricing in 50 basis point hikes consecutively for a few meetings ahead of us, and yet the Bank of England is constantly pushing back against that narrative and makes it very difficult to realize what's already priced in. So when you put those factors on the table, sterling is still going to go lower.
Shab, I got like 8 more questions. You got to go, but please come back soonest as you can. These are some abrupt calls here from Shab Jalan. It's a different landscape out there for all of us, investors, including Jerome Powell, with the kind of moves that Credit Suisse is talking about. Mr. Bullard with headlines coming out fast and furious. Email, Qantas from Perth emails in and says, Tom, forget about the McDonald's burger in Switzerland. He talks about the Bank of Japan and Kaylee, the impact of the new Oyako teriyaki burger and what weak yen means seriously to the whole domestic system of Japan.
Yeah, maybe cheap fast food, not so cheap. Tom, it's not just the teriyaki burger. Imagine
the teriyaki burger.
2020, was I 20? Maybe 19, Japan. I'm out in Osaka. I just want McDonald's, and I am greeted with a huge poster of chocolate-covered French fries. It's a thing. Would you ever put those two things together?
No, I would not put those two things together, but I'm only, I'm down daily. My executive lunch at the 3rd Avenue McDonald's, so, it's a little different there as well. Lisa, we have bonds on the move. I'm sorry, we've got a higher yield regime. What's the why, do you think?
Well, why have we seen such a rally so far this year? I mean, this month, I shouldn't say this year. It's been a complete sell-off this year. This week, we've seen a little bit of a reprieve.
Give it all back, yeah.
When do we all give it all back? Do we go to a Mike Bell peak yield kind of position in the world? Are we looking at one retracement of higher inflation, of an aggressive Fed, and the same narrative that we seem to have abandoned this week?
By this afternoon, quickly, Lisa, do we see curve inversion on the 210 spread?
People are looking for it later this year, whether it happens at the end of today. I'm going to leave that to you to decide. And Jan Hatzius, who you said moved the needle, so
I'll wake up after the surveillance nap, and maybe we'll see that 3 basis points right now. The difference in yield between the 10-year and the 2-year yield. Futures up 27. Stay with us. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg Surveillance. Good morning, everyone. Futures up 26, green on the screen. VIX from 32 into a 28 level this week. Optimism. Lisa, help me with yield here right now. I need help on the data check. We were under 3%. We're now at 307. You really wonder where we'll be at 3 p.m. this afternoon.
How quickly things are moving. And just to give some perspective, in about a month, yields on the front end rose by about a percentage point, which is an astronomical amount in proportion if you think about where it has been. And then it's come in 50 basis points in about a week. I mean, if you think about how much we've seen these absolute whipsaw moves, how much more can we see going forward, Tom? I'm also looking at 10-year yields also indicated upward. The why? I don't know. Maybe it's St. Louis Fed Chair, President, Jim Bullard coming out and saying that he wants to front load it. I don't know if you can really give a narrative to this other than really jumpy markets.
Jumpy markets and lots of really good conversation today. For Global Wall Street, this is not only the conversation of the day on fixed income for Bloomberg Surveillance, but indeed for the week, and can I dare say for Q2. Ian Lingen is out of Minnesota in the Carlson School of Finance. It is absolutely definitive with a tour of duty at Yale as well, and holds court at BMO Capital Markets and writes absolutely the most dense note on fixed income dynamics on the street. We're thrilled he could join us in studio today. Ian, welcome to Bloomberg. I'm going to cut to the chase. Forget about the y-axis, moving yields. Your note right now is on the mystery of the x-axis as Bullard talks about front loading and that. Give us the nuance to the pro audience of the x-axis dynamic, the first and second derivatives of the time change we're going to see.
Well, I think that this is the most important conversation in financial markets at the moment. It's really the answer to the question, how can Bullard be talking about a 350 terminal rate when the reality is that two-year yields are trading at or below 3%? It really comes down to the 24-month moving window represented by the two-year notes. And effectively what the market is saying is you might hike now, but you're going to have to start cutting much sooner than in prior cycles.
Leave fixed income and go over to Jan Hatzius at Goldman Sachs Economics, where he and I talked about core CPI and the idea that we don't have a real understanding of the rate of change of how core CPI is going to come down. Do you share that uncertainty?
I certainly do. I would add one nuance, however, and that is all inflation is the same at this moment for the Fed. Headline inflation, core inflation, they've made no distinction. That's interesting because in the past, they would always focus on core inflation over headline because it was less volatile. But the realities of higher energy prices, higher food prices, and the fact that inflation has become the political touchstone at this point makes all inflation equal. And I think that will change, but not until the midterms.
Ian, is peak rates, it's peak yields, have we already gotten past that? Are we basically at a place where you can say definitively that that is an accurate characterization of what we've seen?
Well, that is certainly our call, but I will note that I said the same thing once we got to 320. So at 350, the logic holds a lot better, but the reality is there's going to eventually be demand for 10 and 30-year paper, and we haven't seen the key investor classes of Japan or certain parts of Europe really come in and start buying treasuries yet. And when we do, that will be worth 35 to 45 basis points in 10s, and that gets you back below 3%, the curve more inverted, and the market even more worried about a recession.
So, Ian, is this supportive for risk assets if the market is going to get more worried about recession and could potentially have to reduce their estimates for margins and profits?
So that is, again, one of the key uncertainties. I would normally say yes, you have a less aggressive Fed, you have lower rates, you should have a good setup for risk assets. But this Fed is behaving much differently than we might have otherwise anticipated. So we could see the possibility of a recession increase, but the Fed, instead of having the traditional response, just push forward and say, yeah, 3.5, we're going to get there. We might push it into a recession, but the reality is it's worth keeping the decades of hard-won credibility as an inflation fighter for the Fed for this one cycle.
Well, Bill Ackman of Pershing Square says the Fed already has a credibility problem and that the bond market is misreading the Fed. To quote one of his tweets, he said that the market is flat out ignoring Powell and the governor's commentary. Expect even more hawkish commentary until the bond market wakes up. Who's asleep, Ian, Bill Ackman or the bond market?
Well, I'll tell you this much. If you look at break-evens, what you can see is that inflation expectations continue to move lower and lower, and that is a vote of confidence in the Fed's ability to control inflation and forward inflation expectations. So one thing can be said, the TIPS market certainly isn't asleep at the moment.
Well, and Jim Bullard, as we said, have said that the TIPS pricing is pretty much right on at the moment. So as we put all of this together, the market has confidence in the Fed's ability to fight inflation. What it has less confidence in is what the ultimate result of that inflation fighting is, how deep a recession will be when and if one arrives. Ian, what is your assessment of that and ultimately what that means for how low we could see yields going?
So I think that at this point, part of the conversation that isn't occurring in the markets is we're just coming off of a negative real GDP print for Q1, which was negative 1.5 after revisions. Right now, GDP for the second quarter is tracking at 0. So if we have a repeat of the higher than expected inflation profile in the U.S., we could actually dip below 0 for real growth in the second quarter. And that would make a recession a very near-term event. Caveat, though, that's not the same type of recession that the market is talking about. The market's worried about a real recession with higher unemployment, that we actually see an aggregate hit to nominal demand, and that's not where we are yet.
Ian Lingen, part of your word, if you're on radio and television, Ian Lingen of BMO Capital Markets joins us right now, the conversation of the week on fixed income. You and I have never seen these bond losses, and I'm fascinated and honored to ask you this question, which is get away from the nuances. The bottom line is the total return index, a Bloomberg Lingen total return index, is negative 12%. How does bond psychology change if people are looking out to 2024, 25, 26 to catch up from these losses?
Well, I think an important aspect of bond losses in the Treasury market is to keep in mind who the major players tend to be.
The people taking the loss.
A lot of the people taking the loss are indexed or attempting to match their index, but everybody's been short. And so on paper, it's a pretty significant loss, but a good portion of the investment community has fared reasonably well.
Okay, but what about mere mortals? They open up their statement from BMO Capital Markets and they start saying profanity about Lingen. The real world out there, this is a bond market we've never seen. It's worse than Volcker's bond market.
I think that the person at home opening their statement, what they're really going to be thinking in the back of their mind is, wow, mortgage rates are almost 6%. That might be the problem. So a little bit of pain in terms of the opportunity to invest in higher treasury yields is one thing, but as the ramifications of the Fed's tighter monetary policy continue to push through to the employment and the housing market, I think that's where we start to get worried.
Ian, how much is your peak yields thesis right now hinging on this idea that the inflationary inputs are transitory, that we still have this stealth transitory narrative guiding a lot of investors and even the Federal Reserve?
I think that the peak inflation or the peak rates narrative is actually based more on the hawkishness and the aggressiveness of the Fed. Regardless of how inflation plays out, what we know is that a lot of what has occurred, at least over the course of the last 6 or 8 months, has been a function of distortions created by the pandemic, the supply side on the energy sector, and now food inflation is very material. Fast forward to this time next year, the year-over-year inflation prints will not be as high. That doesn't mean it was necessarily transitory. That either means that the Fed was that much more hawkish or, in fact, prices moderated just based on demand.
Ian, while we're fast forward to 10 a.m. when we get those UMISH sentiment numbers, is the bond market going to latch onto more of the pure sentiment read, how bad it is and what that means for growth prospects, or the inflation expectations and what that means as to whether or not the Fed is actually going to have to be more hawkish for longer if that is becoming entrenched in the economy?
I think that the headline consumer confidence figure at record low levels is extremely telling. And when we look at the correlation, it really comes down to gasoline prices and equity performance. And both of those have been going the wrong direction for there to be any additional confidence. I think that we're going to focus on confidence over inflation expectations because the Fed has communicated that they're going to do everything it takes to keep inflation anchored.
Very quickly here. Do bonds have catharsis? We think about stocks going down, VIX of 40, et cetera. Does that happen with bonds? Does everybody sell at the same time?
So there does tend to be key moments of capitulation in one direction or the other. And right now, as I mentioned, the vast majority of the market is short treasuries. There'll be a point where people wake up and they say, I don't want to miss out on these higher yields.
Wonderful to see you. I have a lot of message here on Ian's research. Again, we protect the copyright of all of our guests. Find that research at BMO Capital Markets. Ian Lincoln with us today. Lisa, you continue the discussion forward in the next hour. Another Faro property.
Yeah, we're going to be speaking on the open with a host of great guests. Rob Waldner of Invesco, Chief Fixed Income Strategist, and Phil Orlando of Federated Hermes. I'm excited to have this conversation about, have we seen peak yields? Is this because of real aggression from the Federal Reserve? And if that's the case, how much has stock markets really priced this in? Because if that is the case, real hawkishness spurring a particular downturn, are stocks being really true to the downturn in margins?
There we go. That's the gloom we need. The toxic brew of hawkishness is, 2-10 spread, it comes in. Will we see inversion today or Monday? Who knows? 3.71 basis points, I should say, the difference in yield there. Curve flattening this morning. 2-year yield all over the place. Higher yield by 6 basis points, 3.07% as well. In the equity market, continued a generous lift, I'm going to call. Day after day, the NASDAQ, I can't give you the 12,000 item, 11,800 on the NASDAQ, up 0.8%. Stay with us on radio, on television. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Actions by the U.S. Senate and the Supreme Court have underscored the deep divisions over gun policy. The Senate voted 65-33 to approve gun safety legislation. It calls for improving background checks, securing schools, and giving states money to combat gun violence. The House is also expected to approve the measure. Senate passage came hours after the Supreme Court issued a landmark ruling that could mean more guns on the streets of big cities. 5 Republican members of Congress are said to have contacted the White House after the 2020 election, seeking pardons from President Trump. That's according to video testimony played by the committee investigating the January 6th insurrection. The congressmen included Matt Gaetz, Scott Perry, Andy Biggs, Louis Gohmert, and Mo Brooks. Wall Street's biggest banks are now set to return tens of billions of dollars to investors. They all passed the Federal Reserve's annual test to their ability to withstand market turmoil. The stress test showed that banks such as JP Morgan, Morgan Stanley, Goldman Sachs could handle what could be a severe recession. In the UK, consumers are starting to crumple in the face of soaring prices. The government says the volume of goods sold in stores and online fell 0.5% in May. The big jump in food prices forced consumers to cut back on spending in supermarkets. Meanwhile, another report says consumer confidence in the UK has fallen to a record low this month. And Europe's travel chaos is about to get worse just as the summer vacation period gets underway. Lufthansa is cancelling 3,100 flights after a wave of coronavirus infections led to more staffing shortages. Travel demand has rebounded dramatically in Europe. That has subjected passengers to cancellations and lines lasting hours. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think Powell is trying to finesse it. I don't think that it's very clear for him what indeed the terminal rate is right now. I think that he's got to continue to guide the market towards hawkishness. He can't go wobbly on the resolution to tackle inflation right now.
Greg Staples, DWS Group, head of North American fixed income, there with really important comments on fixed income. And we really thank Ian Lingen of BMO Capital Markets for darkening the door today as well. Right now, to get your weekend started, to really begin to think about the next 6 months, Kriti Gupta, with perspective here, what are you talking about, Kriti? Euro something?
We're talking about euro dollars. We're talking about it in the context of what they're pricing in when it talks about not just rate hikes, but rate cuts. If you actually look at the 12-month forward euro-dollar spread, now essentially this is what the bond market right now is pricing in going at 12 months out into the road, so essentially in mid-2023. And for our radio audience, essentially what you need to know is that they're actually pricing in about 43 basis points of negative rate. So the idea here being that in mid-2023, at least for what the current bond market is pricing in, they're going to start to expect perhaps some recessionary pressures or like pressures to which they expect that the Federal Reserve will have to act using some of those rate cuts. And that's really what this chart of the day holds. Whether that actually happens or manifests in a year's time is another story. But it's significant to know that those bets have been increasing in the past few weeks.
This is a Bramwitz territory. Kaylee and I have absolutely no comment on this whatsoever. Pretty good to thank you so much. Seriously, Kaylee, my head is spinning over all this Fed babble.
It's been hard to follow, and that's really been true for weeks and months now, Tom, ever since the hawkishness started ramping up. I don't know if any of us can really assign a narrative around this bond market or this equity market for that matter.
We will see. Now, we've had a lot of important conversations this week, but we've saved the best for my last of the week because, and this is serious, the airlines are a mess. We are honored to bring you senior research analyst at Cowen, Helene Becker, working with the wonderful Kai von Rumer. They are truly the adults of the industry. Helene, I'm going to ask the question that every single listener and viewer wants to know, including Mrs. Keene. Is this turmoil in airlines sacrificing or risking the wonderful safety record of commercial airlines?
No, not at all. The U.S. And really worldwide, airlines pride themselves on being safe, safety first. That's the most important thing. And I think that will be the case going forward. The issue with delays and cancellations, of course, is a whole nother story.
Okay, I don't want to make jokes about this because the surveillance team personally has seen this. We've all got our own stories on this as well. Let's start with the pilot shortage. They're not going to fix this by Labor Day, are they?
No, not at all. Can't be. So think about it this way. Over the past 2 years, approximately 10,000 pilots retired or left the profession. The industry needs to hire to replace that just to get back to where we were in 2018. So that's about 10,000 pilots right there. And then there are about 2,000 pilots retiring annually this decade. So when you think about replacing those 10,000 plus the additional 2,000 that we need just to replace retiring pilots and then pilots on top of growth, we estimate we need something like 15,000 pilots this year, another 5,000 pilots next year, again in 2024. So you're looking at 20,000 pilots over the next 3 years, 2.5 years. And we just don't turn that many out.
Okay, so Helene, you have a labor pilot shortage that is leading to all of these problems, leading a consumer like me to look at all these headlines of flights, thousands of them canceled each and every weekend, and that when I'm shopping for flights, I see how much ticket prices are still going up. I'm looking at that saying, I'm going to take the train. I mean, at what point does this just exacerbate the issue of demand destruction?
Excuse me, Kaylee, is Helene Becker your travel agent? Is that what you're doing? You're booking a flight with a lady from Cowen? Come on.
No, but I'm I'm sure as an airline analyst, she analyzes consumer sentiment around airlines, specifically these higher prices, which to this point, airlines have had success in passing on some of those higher fuel costs through the mechanism of raising ticket prices. But as Americans pay more for their own gasoline, Helene, how long can they really do that?
Good points here. Not only is it higher gasoline prices to get to work, right? It costs many people twice as much as it was costing them 6 months ago. And then you have higher food costs, higher rent, and so on. So yes, this is a major problem. And ticket prices, to your point, are going up. And we don't see them coming down because you don't have enough staff. And it's not just pilots, by the way. People don't realize that the U.S. hasn't trained any air traffic controllers for 2 years. They're on the hunt now to find more. I think I looked at the numbers yesterday, and we saw something like 4,000 air traffic controllers are needed. It takes 4 years to train an air traffic controller. And then another 2 years for experience. So we're short them. We're short pilots. We're short staffed at every airport, and ticket prices are going up. And yes, you are absolutely right. There is a point at which consumers are going to say, enough, we cannot take this anymore, and we'll stop traveling. And the airlines are kind of pushing the consumer into that direction, aren't they? Because they are reducing capacity, so there aren't as many flights available. And when there aren't as many seats and there's a lot of demand, they have to raise ticket prices, and then people opt out. And to your point, Kelly, they either train or drive. Not that driving is cheap, but exactly so. They make other choices.
Okay, I know you love United Airlines. Kirby's got his hands full right now. Look at Newark this week. Are you going to move your buy-hold sells based on all this trauma?
Well, we're always reviewing our ratings for valuation.
Well, give us a heads up. No one's listening. Come on, Helene. You don't have to publish Monday. Give me some news I can work with here.
Yeah, so we review our ratings on a daily basis based on valuation and what we think the airlines can earn. And we still have the airlines profitable this year. And next, for that matter, but we're hoping that costs start to at least flatten out.
Helene Becker, thank you. Great of you to come to us on a Friday. Really appreciate it. Helene Becker of Cowen on all the challenges that are out there. Kaylee, I look at the weekend. Last weekend, I was watching BitDog move tick by tick down under 18,000. Why does Bitcoin go down on the weekend? Is just everybody steps away?
It is such an unusual phenomenon. There's a lot of people that have been tracking this. So much of the price action comes when U.S. equity markets are closed. I wish I had a clear reason why, Tom. I don't have one, but it is definitely a really interesting phenomenon to look at. I will say this weekend in Bitcoin has been much more boring than last week was overall.
Let me do a data check here to exit out here. Lots more coming. 10 a.m. in 1 hour and 4 minutes. Arguably the statistic of the week. I know it's coming late. Stay with us, folks, for the Michigan inflation expectations statistic. Chairman Powell will be looking at that as well. Futures up 25, Dow futures up 182, yields reverse, higher yield 3.07%, and the 2-year yield. What's great in television is when someone in the control room actually has to talk in my ear for the first time and understand the weight and pressure. We are thrilled at Bloomberg Surveillance to say Rachel from Swellesley has survived the last 10 minutes. We welcome her into the trenches of Bloomberg Surveillance. Please stay with us. Again, inflation expectations, Michigan in 64 minutes. This is Bloomberg.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro as we see possibly the first up week in 4 weeks. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
We begin with the big issue. Has bad news officially become good news?
We're probably in a slow patch.
It's going to be really difficult for the Fed to hike rates aggressively.
If supply side prices slow with demand, then the Fed is likely to back off.
We're seeing the market sort of shrug off some of the hawkish data.
Basically, will be one of a recession by the end of this year.
A more shallow recessionary scenario.
It's probably coming in the second half.
A shallow recession.
We're doing things in the present based on backward-looking data.
The fundamentals still remain quite strong.
It's still not too late to try and get, your position for kind of wealth preservation.
It's a space that we're looking at very closely and are thinking of going back to the long side fairly soon.
Investors that I'm talking to, they're starting to get back into the markets, and that's a relatively good sign.
It's a muddle of potential Fed policy in the face of a slowing economy. Joining us now to discuss, Invesco's Rob Waldner and Ella Hocha of Pictet Asset Management. Ella, what's your view on why we've seen bonds rally this week in the face of the R call and this expectation for a hawkish Fed?
Well, we've had an aggressive repricing in rates this year, probably the worst start to first half of a year in probably as long as we can recall, 1700s, some are saying. So probably due a respite, given positioning had gotten very, very short on both US and European side. So, it's normal to expect some sort of retracement from that. That's more on the sort of technical market side. On the economic side, we've been seeing signs of a slowdown in the US and also elsewhere in the world. And so that's probably causing some jitters with regards to this, hawkish Fed and slowing economy. We've not really seen that happen before. And so making markets nervous and therefore giving bonds a bit of a bid here.
So, Rob, have we seen peak yields?
I think we have, Lisa. I think we're in a situation where it was higher inflation that drove bond yields higher for the first part of this year. That's over. We think now it's about growth and financial conditions. And, growth, everything I look at in growth is slowing. So whether you look at PMIs, you look at inventories, you look at the housing market, you look at, it's all slowing, and financial conditions have tightened quite a bit, whether it's mortgage rates, M2, money supply, it's all telling you that the economy is slowing. So if we're now in an environment where it's about growth and financial conditions, it makes sense for the bond market to peak out here. And we think there's value in bonds, particularly in high quality credit bonds.
New York Fed President Jim Bullard, I should say St. Louis Fed President Jim Bullard, speaking at a panel earlier today. Take a listen. I think that we are working on that, Sat, but he was talking about front-loading rate hikes and how we're going to end up with a perhaps peaking out at 3.5% Fed funds rate, sort of like what we're seeing being priced into the market right now. Ella, do you agree with what we just heard from Rob, that we've seen peak yields, that we've seen a softening, the Fed is going to be aggressive, but they will be able to follow that up with rate cuts?
I mean, it's possible that we've seen a peak. We're not entirely convinced yet, and the reason for that is we still don't have strong visibility on the inflation side. As we've seen, those numbers have been pretty sticky for quite some time. So that's one thing. And then the other thing is the Fed seems to be pretty keen on tightening policy here. And with wages picking up significantly here, it's very difficult for them to pull back right away. So we don't think this tug of war is over for markets, but we do agree on one thing, that there is some value now appearing in treasuries, and certainly the belly has been showing that. So the 5 to 10 year part of the curve has been giving you some signals to that effect, but it's by no means over.
Yeah. Well, Rob, what's your sense about whether bad news is good news at this point when it comes to riskier securities within the credit sphere, within even equities?
Well, I think that that bad news, good news narrative is one that involves the Fed and financial conditions. And what worries me is the Fed is firmly locked into moving interest rates based on trailing data. I mean, we're going to get this Michigan inflation expectations out later today. I think that's kind of really a moving average of past inflation. So not only are we looking backwards at inflation, we're looking at a moving average of inflation. And the Fed seems to be indicating that that's what's going to be the driver of their policy. And that makes me very concerned because, bad news could be bad news in that scenario, because the Fed may not react to that bad news and may not give us some relief. So that's why I say, you want to be in higher quality, you want fixed income, and you want to be in higher quality fixed income, probably because that's where you can get through this sort of bad news is bad news kind of scenario.
And that's certainly what we're hearing from Chair Powell, his commitment not giving much comfort as weak data continues to roll in.
It's unconditional. Our commitment is we really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment.
Bloomberg's Michael McKee joins us now for more, and we were talking earlier about that 10 a.m. data dump that could be bad news being bad news.
Well, it's an update of what the Fed saw earlier this month, so it may not be decisive for them, but they will keep watching it into the coming months. But here's the interesting thing. The economy is doing what the Fed asked it to do. It's slowing down. The bond market, the one marshmallow folks in the bond market are doing this instead. They're thinking the Fed's going to go too far, that they're repricing already for recession. Now, it's interesting because the white line is where we are now. The blue line is where we were on Fed Day, and you can see how far, especially the short end, has come down. But they're still above what the Fed considers to be neutral, around 3%. So they're still pricing in some tightening. They just think that it might end a little badly. There are some reasons for concern. Jim Bullard was very optimistic this morning, saying he thinks the economy can get through this just fine, and we're at the beginning of a long expansion. But Adam Tooze at Columbia University put together this list of hangovers, potential crises that we could still face over the next year. You can see same suspects: COVID, the energy crisis, stagflation, hunger. They worry about sovereign debt crises because of course, what's going on around the world in emerging markets. And then you got Italy and the war, and then we've got an election this fall. So a lot of factors still out there that are outside the Fed's control that could lead to that recession scenario. But here's the thing that worries people the most. the fear of recession can be self-fulfilling. Look at the number of newspaper stories talking about recession, and then you see the University of Michigan's Consumer Sentiment Index, consumer sentiment plunging as recession talk rises. We might talk ourselves into it if none of those other bad things happen. At this point, the Fed is betting on something a little bit better, but we got to see.
And Michael McKee will be watching for that today, and perhaps that 10 a.m. number will change the conversation. Still with us, Rob Waldner and Ella Hoja. Rob, I want to get your sense on the yield curve and what it's signaling currently. We are looking at an increasingly flat yield curve, but sort of a stasis, right? I mean, we've really had a calm this week. Are you still looking for a yield curve inversion? Is that the most likely path of travel?
If the Fed continues to be looking backward at inflation, I think that's probably what we will see, because we have growing sense of slowing economic momentum. I think a peak in forward-looking inflation expectations from our perspective, but the actual data is going to remain high. And if the Fed continues to do 75 basis point hikes while we're doing that, that's going to invert the curve. I think that a great analogy here is, the early 1990s, the early part of my career, when after the unification of Germany, we had a massive fiscal boom, much like we had here in the U.S. in this pandemic. And, the growth picked up, inflation picked up, and the Bundesbank got very aggressive with their monetary policy, and they really inverted the yield curve quite a bit. And I think if the Fed is backward looking and looking at inflation, that's the kind of model we could have here.
Meanwhile, you've got Bank of America talking about some of the fund flows. Michael Hartnett writing, quote, year to date, investors have bought $195 billion of stocks and sold $193 billion of bonds. 2022 capitulation has been in bonds and not stocks. Bank of America bull and bear indicator remains at maximum bearish level of 0. B of A global breadth rule contrarian buy signal triggered June 21st. Ella, has there been this sort of shift into your interest in stocks away from bonds, considering the peak capitulation there, and perhaps not so much in stocks?
Well, I'll talk with a macro head to that, because obviously I'm a bond PM. So, we're not seeing that, certainly not on the flows. We're seeing some interest in quality bonds, so treasuries, as I was saying earlier, from our clients. But we're still seeing no interest really on the equity side or in the sort of riskier assets side. There's still quite a bit of liquidation going on. Now, for us, it's really, making the sort of the call to get really bullish here. You have to make some big calls on, one is inflation, and the second one for us is the Fed. So you got to believe that the Fed will be turning dovishly from here. And as I was saying earlier, given where the level of wages is and where inflation is, it's very difficult to get bulled up at this stage. So we're not convinced yet by this. Potentially we're at capitulation stage. Absolutely, we agree with that. But is this the time to actually buy the dip? We'll probably say no.
Ella Hoja, Rob Waldner, both of you are sticking with us. Right now, we want to take a look at some of the stocks moving ahead of the opening bell. Here is Abigail Doolittle.
Well, Lisa, you were mentioning the fact that the futures, the indexes, the stock indexes here in the U.S. on pace for the first up week in 4, the best week since the last up week at the end of May. So the question is this the start of a bear market bounce? And if it is, we of course need big tech. Big tech is participating, Microsoft being one of those stocks, up 1.1%. This as they may, in fact, do that $40 billion debt deal to rebuild their cash. Twitter up about 0.4% on the news that Twitter has given Musk's team the live account details so that they can do some of the bot work. So folks optimistic on the idea that that could help the deal go through. FedEx popping up 3.1%, a strong quarter, a good start for the new CEO. Higher freight rates lift the profits for the company and their outlook. And then finally, Alibaba, one of this week's big winners, up 2.8% on the day. On the week, up 9% from the March lows, up 60%. Lisa, that of course is a $120 billion ad. All of this on the possibility of Ant Financial going public. Plus, it seems that Beijing is being a little bit more amicable for some of these tech stocks in terms of regulation. So a nice rally there for sure.
Yeah, perhaps easing up as they face off into economic weakness there. Abigail, thank you so much. Coming up, President Biden heading to Europe amid ongoing battles with energy costs.
The meeting was a productive dialogue focused on creating an opportunity for industry to work with government to help deliver needed relief to American consumers.
We'll take a look at that still ahead as oil very much the forefront of some of the moves this week, seeing a bit of weakness until today, where you are seeing a bit of a rebound, just slightly on the heels of the supply-demand dynamic and not perhaps as much the recession call. We are seeing S&P futures climb ahead of the open, up 0.8%, yields climbing to price down in the bond space. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The world's most influential central banks meet at the ECB Forum in Sintra, Portugal. Don't miss a conversation with Jay Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens. Join Bloomberg's Francine Lacroix for coverage from Tuesday, June 28th on Bloomberg TV and Radio.
The meeting was a productive dialogue focused on creating an opportunity for industry to work with government to help deliver needed relief to American consumers. What Secretary Granholm has called on is for her team to continue having conversations with the oil companies.
The Energy Secretary's conversation with top oil executives yielding little progress in lowering prices at the pump. But President Biden turning his focus now abroad, heading to the G7 summit kicking off on Sunday. Bloomberg's Anne-Marie Hordern joining us now from Washington, D.C. What are we expecting to hear coming out of some of these G7 meetings and frankly, just some of the conversations out of Riyadh as well?
Well, Lisa, you're really hitting the nail on the head when you think about setting that up between what Secretary Granholm had at a meeting yesterday with oil executives to the fact that the president is now going abroad, because this is a moment in time where foreign policy and domestic policy concerns are really converging. And of course, that is because the price of oil and the fact that it is going up, this premium we have, this geopolitical premium, is being exacerbated by Russia's invasion of Ukraine. So the first part, I would say, is some talks that potentially could have on the G7 when it comes to the president's most important and dire issue right now, which is inflation, is potentially a discussion, in the very least, about price caps on Russia. This is something that the Treasury Secretary Janet Yellen has spoken about before. How do you keep Russian crude on the market, but make sure Russia is not increasing their revenues and their profit from that crude? So that's potentially something that's going to be discussed. And then, of course, Saudi Arabia, which is a trip he's going to take in July. obviously oil and the traditional exchange of security for oil will loom large, even though everyone I talk to, whether or not it's in the kingdom or in Washington, say that there's a lot about this relation and other pillars and deliverables that they will be discussing.
Anne-Marie, before you go, how important is it for the U.S. to have a leadership role when talking with European allies in terms of providing them with more gas and with more crude from the United States and helping them secure it elsewhere in order to continue pushing back against Russia?
Well, they've been doing this for months, and they've had those conversations, frankly, well before Russia's invasion of Ukraine. The U.S. officials were working alongside their European counterparts, making sure they can try to shore up liquefied natural gas instead of taking that natural gas through pipelines, if it came to that point, from Russia. The big issue for Europe, Lisa, which you know, is that when it comes to natural gas, less so with oil, it's really an infrastructure problem. Europe is built to be delivered with this natural gas via pipelines, while a lot of them are still struggling with LNG terminals. So really, this war has pivoted a lot of what you see going on in Europe, especially in Germany. They didn't have any LNG terminals, and now they're building two.
All right, Anne-Marie Hodurna in Washington, D.C., thank you so much. Ella Holja and Rob Waldner still with us. I would love to get your opinions. And Rob, I'll start with you about oil and how we did see it cool off this week and how much that was really a huge driver of some of the price action that we saw in the bond world.
Yeah, well, oil, I think it's important with energy to think about the near term and the longer term. In the near term, if I'm right and growth is slowing, then demand for energy will cool a bit. And, you know, you may be able to see a period of more stable energy prices, and that would also fit with inflation kind of, or the energy part of inflation stabilizing. But I do think we need to really, the policymakers need to get to grips with the medium-term issue, which is as the economy grows, it needs more energy, and we need to have a source for that energy. And we've been underinvesting in traditional fossil fuel energy sources for a number of years. And if we don't solve that problem in some way, either upping investment in traditional sources or finding or more alternative sources, this is going to be with us for quite a while. And so we need to think about this as a medium-term issue. It's really a policy, a longer-term, medium-term policy issue. And our policy has been, has been constraining investment, not supporting investment.
But Ella, putting policy aside for a moment, I'm just wondering about the price action in markets, because this week, all of a sudden, the gloom really pervaded the oil world in a way that it hadn't until now. It really had been a supply-side story that was really not meeting demand. How much do you expect that to underpin some of the movement that we see in the bond world, considering the fact that all of a sudden that takes some of the pressure off?
Absolutely. We're seeing that reflected in the pricing, as you correctly point out. It's showing up in the break-evens. It's showing up in the five-year inflation swaps. So the market taking away quite a bit of that premium down, and all of that happening in the course of the past week or so. So, yeah, absolutely, I agree with the previous speaker in terms of, as you see oil prices coming down on the face of potentially weaker growth ahead of us. That makes sense that you shave some of those expectations off. But to us, that's obviously a positive driver for bonds, at least over the short term. But it's very difficult to see how much that contributes into inflation falling so substantially that the Fed has to back off from this very hawkish path. We're not convinced that we have enough evidence to that effect yet. And I bring back wages being very high here, and in terms of inflation expectations with consumers, etc., those are still elevated. So too early a time to tell.
Yeah, and just to bring you some headlines from some of the meetings being held in Europe on oil caps and on oil policy, the European Union's von der Leyen saying that U.S. LNG deliveries are up to the European Union are up 75% this year, and you have Mario Draghi talking about how talks on a cap to gas prices will resume after the summer. Ella, but to your point, and this is really important, how much is the volatility in oil prices driving volatility in bond prices and creating a really confusing signal that may be a bit divorced from what the fundamental narrative should be?
It's one factor. It's not the only factor, but it's been an important one. But let's, I probably would quote Powell here and say that there was inflation before we even started this conflict in Ukraine and sort of exacerbated the issue. So, and that's coming also from food prices, not helped from the conflict, but also from other issues. So it's broad-based. When you look at the consumption basket, you're seeing those inflationary pressures throughout. So that's why we wouldn't just point at oil as, potentially falling and solving this matter. For us, it's still a background where we have much higher inflation than we're accustomed to.
Yeah.
And it's too early to say that that's behind us.
Rob, final word on the influence of oil variations and fluctuations on the level of bond yields.
I think the driver for both bond yields and oil is this decline we're seeing in growth expectations. As oil comes out of as oil prices come down, that does, I think, feed into break-evens, like Ella said, which gives us some relief overall. But we still have very high real yields in a recent historical sense, and that's due to the Fed. So there's only so much, the break-evens can do.
Rob Waldner, Ella Hoja, thank you both so much for being with us today, and have a wonderful weekend. Coming up, the morning calls, and later, FedEx alleviating Wall Street's corporate profit concerns. That conversation still ahead with Federated's Phil Orlando. The opening bell is coming up, and perhaps we will snap 3 weeks of straight losses with a fourth one of gains. This is Bloomberg.
And behind me, you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Let's take a quick look at the markets. They are extending gains ahead of the open. The Nasdaq up 1%. S&P futures up 0.9%. How much is this being underpinned by what we've seen in two-year yields so far over the past couple of months? A huge surge in yields, about a percentage point over about a month, and then absolute whipsaw downward, about 50 basis points in a week. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley upgrading Altria to equal weight, $43 price target, seeing a more balanced risk-reward following recent declines. Next up, Citi downgrading Hess to neutral, $110 price target, expecting economic headwinds to keep a lid on energy stocks. And finally, RBC Capital cutting its Meta price target down to $200, pointing to weakening trends emerging in ad spending. Coming up, futures pointing to more gains as stocks look to snap a 3-week losing skid. That conversation coming up next with Federated's Phil Orlando. The opening bell is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, possibly the first up week in 4, with the NASDAQ leading the way up nearly a percentage point, up 0.9%. The Russell up 0.8%. The S&P 38.31, 0.8% gain. You're seeing the bid into yields, so the bid into bonds really take a step back as we do see a bit of that classic risk on kind of feel, and we see the euro asserting itself over the dollar. Crude getting a bit of a lift today as recession fears fade. Right now, let's take a look at some of the stocks moving at the opening bell. Here's Abigail Doolittle.
Well, Lisa, with the S&P 500 poised for that first up week in 4, as you were just mentioning, lots of participation from lots of the big stocks, starting out with the shares of Apple. Apple is on pace to climb 6% this week, the best week, not surprisingly, since the end of May, up about 1.2% as investors start to embrace tech once again, thinking that maybe yields have peaked. Let's see about that, but that, of course, takes off valuation concerns. Now, yields peaking, not great for the banks, but Morgan Stanley up 1.7%. Of course, the big banks passed the Fed stress test with flying colors. I believe Shanali will be talking about that in just a little bit. Morgan Stanley, I think the best of those tests. FedEx up 3.9%, very strong quarter. They lifted the outlook on rising freight prices, so managing rising costs and supply chain issues quite well. And then finally, take a look at Zendesk. The $7 billion customer support company is now roughly an $11 billion customer support software company. This on a buyout from a group of private investors for $9.5 billion, Lisa.
Abigail, thank you so much. This week's bid into bonds providing some relief for big tech stocks. Let's bring in Kaylee Lyons for more. Kaylee.
Well, Lisa, I feel like I have to preface everything I'm about to say with some context, because while this week has been more positive, it has been absolutely brutal for tech this year. The NASDAQ 100 is still down about 28% year to date, at least as of yesterday's close. And of course, we've seen an immense amount of selling pressure in the bond market as well, with the 10-year yield up 150 basis points since the start of the year, which is a large part of the reason why tech has been down so much. But it has been a very different story this week, as we've seen the 10-year yield coming in about 13 basis points on the week. We've seen the NASDAQ 100 rally about 5 percentage points on the week. And you can see the money coming back into tech reflected in the flows as well, and that we've seen more than $1 billion collectively of inflows into the Qs and the Vanguard Tech ETF. At the same time, take a look at where the outflows have been. Yes, the broad market, the S&P 500, SPY, which tracks it, but also value and Russell 2000 stocks, more cyclical value-oriented areas of the market, which really speaks to the kind of defensive tilt we are seeing as people talk more and more about, yes, the R word, the chances of a recession. And that defensiveness has also been reflected into the bid we've seen in bonds. And I would like to just say to anyone out there who has been talking about the death of the 60-40 portfolio, it came back to life this week. We are looking potentially at the third 1% plus gain for 60-40 so far this year, Lisa.
Kaylee Lyons, thank you so much. Out of tech and into safety, just following on to the theme that Kaylee was just talking about, here's Taylor Riggs with more on that defensive tilt. Taylor.
And certainly a little bit in terms of what the market, Lisa, is starting to price in. You take a look at defensive stocks relative to the MSCI World Index and sort of that relative value, that comparative ratio. You certainly are starting to see defensive outperform a little bit, though we were joking yesterday on the close. If you've Clorox, Procter & Gamble, and Kimberly-Clark all up at least 2.5% yesterday, that doesn't feel like a good thing. Romaine's already been hoarding my toilet paper in March of 2020. I certainly do not want to go back to that. Let's talk, though, about some of the recessionary times, and that's sort of what the market's pricing in. When you think about underperformance of the stocks, of the commodities, of the financials underperforming the market, at least in the last month, that's sort of where you start to get a little bit worried about sort of the broader economics. We talked a lot about copper and oil, for example, on our program in the afternoon. I think what is interesting, though, when we take a look at sort of the flows, and Kaylee was sort of mentioning this, right? The outflows and the going back into cash. What is that telling you? Global equity funds did see the biggest outflows in 9 weeks. Investors are going back into cash. Now, as you know, after inflation, is cash trash or is cash king?
Taylor Riggs, thank you. Definitely varied opinions on that. Right now, we are hearing about St. Louis Fed President Jim Bullard, his latest comments out of Zurich, where he is speaking at a UBS conference saying, I actually think we will be fine and that recession concerns are overblown. Joining us now, Phil Orlando of Federated Hermes. Do you agree, Phil, that so far recession calls have been a bit overblown?
Well, you take a look at benchmark 10-year Treasury yields just in the last fortnight. We were at 3.5%, I think, last Wednesday. This morning, we're sitting here at 3.1%. So you ask yourself, how is it possible that the bond market could have rallied so much in the space of, 2-week period? And I think the answer is the bond vigilantes firmly believe that if we're not in a recession now, we're grinding towards one over the course of the next year or two. So professional investors are thinking that recession is probably inevitable.
Do you think that this is an opportunity in order to go back into big tech, which is something that we did see this week?
No, that's premature. That we've had, a bounce in equities over the course of the last week, no question about that. But I think that's more of an oversold bounce. You look at the data we're looking at. We're going to get an update on Michigan sentiment at 10 o'clock. That number's sitting at a record low. The savings rate sitting at a 14-year low. Inflation sitting at a 40-year high. And let me bring in a data point from yesterday, the initial weekly jobless claims. Yesterday was the survey week for the June jobs report that we're going to see in 2 weeks. Initial weekly jobless claims are up by 38% over the course of the last 3 months. So I think we are looking at a deceleration in economic growth, yet the Federal Reserve, having given us a 50 basis point hike in May, a 3/4 point hike in June, I think we're going to get another 75 basis point hike in July. And then that takes us to Jackson Hole. The Federal Reserve, I think, is going to be very data dependent. I think that Jay Powell would love to get up to the podium and declare victory, that we've seen a peak in inflation, that the Fed will begin to start to downshift to a series of 50s starting with the September FOMC meeting. But we haven't seen any evidence yet that inflation has in fact peaked. We think it will peak at some point over the next couple of months. But I think we're basically in a wait-and-see mode. Our models, our dashboards are suggesting an increased risk of recession somewhere in that mid-24 period. But given the accelerated pace at which the Fed is tightening policy here, maybe that recession risk should push forward into early 24 or late 23.
Yeah.
So I don't think we can declare victory on the recession question just yet.
Before we move on to the next phase of looking at banks and some of the specific sectors, Credit Suisse has been looking at mixed signals in the equity market. I'd love to get your thoughts. Breadth of the sell-off and implied correlations bullish, this according to Credit Suisse, but earnings revisions and positioning are bearish. Equity is seeing consistent inflows despite depressed sentiment. This supports our thesis of fully invested bears. Given your bearishness, Phil, when you talk about the potential pain ahead and the fact that recession may not be overpriced in markets right now, what's the low end of your S&P call at this point? At what point do you start to feel like things are bottoming out?
So we're sitting at about 3,800 on the S&P 500 right now, but our best guess is that the second quarter earnings season is going to be very challenging. Our best guess is that we are going to be looking at a 3,500 S&P 500 at some point in the late August to early October period. If we could get the market down to 3,500 over the next couple of months and then begin to intellectually price in peak inflation, peak Fed, peak negative earnings comparisons, then I think we might start to get more comfortable looking ahead into the fourth quarter to begin to put, dip that toe back into the water.
One sector that's been really beaten up has been the banks. The Fed out with the results of its annual bank stress test. Bloomberg Sonali Basak joins us now for more. Not exactly as stressed as their stock share price, has it been?
Not exactly as stressed. Of course, all of the more than 30 banks had passed the stress test, Lisa, but the devil here is always in the detail. When you look at how much the excess capital was left over after the stress test, that number was, that percentage was worse than last year. Remember, a 2.7 percentage point decline in the aggregate CET1 ratio is larger than what you saw last year. Part of that is because the provisions for loan losses this time around were lighter, and credit cards and commercial real estate collectively has a 16% projected loss rate in this stress test and an almost 10% projected loss rate in commercial real estate. So that will affect the regional banks more. You also have Jefferies expecting that Bank of America, Citigroup, JP Morgan may also have to raise their internal target ratios, which would mean less room for buybacks moving forward. But the question here is, what does that really look like moving forward? We already know the banks have already guided towards less capital return to some degree, but for different reasons than what we're seeing in the stress test. You have JP Morgan talking about a preference towards acquisitions. You have Goldman Sachs also talking about putting money back into the business and getting higher ROEs that way. And you have Citigroup also guiding for a tougher macro environment ahead. There are a lot of reasons to have muted expectations for buybacks, but that tension, Lisa, will always exist between whether the banks give that money back to their investors or choose to lend it in this rising interest rate environment when lawmakers and the country may want them to be lending.
Sonali Basak, thank you so much. RBC's Gerard Cassidy weighing in after all the major U.S. banks passed their stress tests, writing, quote, "The results reinforce our conviction that the capital position of the largest U.S. banks remains strong, and they will weather a recession significantly better than the 2008-2009 recession." He went on to say in a conversation with us this morning that investors still had too much of the memory of 08-09 and were not valuing some of these banks properly. Phil Orlando, still with us. Phil, do you agree?
Absolutely. I think Gerald and Sonali are both spot on here. We've got a value bias, a defensive bias at Federated Hermes, but banks, financial services are one of the areas that we like. We've got a buy on financial services as well as energy, healthcare, and materials. So we think that that financial stocks are significantly undervalued relative to their prospects. We think the balance sheets are in great shape. The financials are being well managed. So I think with as cheap as they are, that's a place to be aggressive here.
Phil, with respect to which banks, are you looking more at the investment banking or are you looking more at the traditional lending?
Above my pay grade. I'm more in the macro area, but certainly a JP Morgan, for example, we think touches upon all of those different areas, well capitalized, well managed, and the stock is cheap.
Phil, when you talk about defensives, at what point do they become overpriced and do you start looking at some of the consumer cyclicals again, considering that we will be entering a new phase at some point of recovery?
I don't think the market has fully priced in how challenging second quarter earnings are. And I think I would be much more interested in seeing A, how bad are those earnings, B, how bad is the guidance, and C, where does the stock market bottom out post-second quarter earnings against a very challenging 88% increase year-on-year comparison, second quarter of 21 versus the second quarter of 20. I don't think the market is fully priced in exactly how difficult the second quarter earnings are post that earnings season, and that would take us, into mid to late August. That would be a period that we'd sift through the rubble and see what valuations look like.
Phil Orlando is sticking with us. Coming up, Wall Street paying close attention to corporate profits, as Phil was talking about, amid growing recession concerns.
You're going to have to look at each company and see how they're handling the labor and the wage cost and the fuel cost that they're facing now.
That conversation coming up next, and it does look like we are building on some of the gains that we experienced throughout the previous 3 days. The S&P now up 1.3%, extending gains. If it finishes in the green, we are looking at the first weekly gain in 4 weeks. From New York, this is Bloomberg.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Actually had increasing margins on some of their freight, which was interesting. They're increasing their fuel surcharges. And so I think you're going to have to look at each company and see how they're handling the labor and the wage cost and the fuel cost that they're facing now.
That was Crossmark's Victoria Fernandez. FedEx overcoming rising rates and labor shortages by boosting packaging prices. This is growing recession fears of Wall Street increasingly concerned about corporate America delivering unlofty profit estimates.
If you have a crack in the earnings story, well, then the multiples are really going to get beaten up and valuations. Let's say they're 15, 16 now on the market, something like that. They can get down to a multiple of 12 or 13, and that means that we have a lot more pain to go if there's a real grown-up recession that's going to happen.
Bloomberg's Taylor Riggs joining us now with more.
And I like that you tied in both Victoria and Jonathan Golub there. Let me start with Victoria's comments. When we think about FedEx, yes, indeed. I mean, you have a relatively new CEO who's been on the job for a couple weeks, really seen full year 2023 bottom line higher than expected, and coming out in that press release and seeing that they are on track to meet those, and also saying that those 23 margins are going to be rising at ground, express, and freight. And that's really what analysts want, Lisa, right? We don't care about the last quarter. We really wanted to see strong performance on that forward guidance. The market likes it. We had that great interview with Jonathan Golub yesterday as well. And I think it's interesting to point out that he is not seeing those signs of the cracks, which is why if you take a look at the terminal chart, those estimates are actually hanging in there. And he actually thinks that that actually could be reasonable. Maybe that isn't too lofty. When you think about the dispersion, when you think about bankruptcies versus widening CDX spreads, all of those signals that he's looking at, he doesn't see a massive recession on the horizon. And that is why maybe in part some of those earnings guidance and those analyst estimates aren't actually moving a lot lower here. Take a look, though, at growth estimates, and indeed profit growth estimates are rising. This is, again, sort of good sign from the street, showing that some of these individual companies can weather some of the inflationary pressures, and indeed, Lisa, pass those on to the consumer.
Taylor Riggs, thank you so much. Following margin pressure, Mundi's head of equities saying, quote, the shoe to drop will be on margins. Companies are still very confident, but the market haven't seen these clouds. You can't have these three clouds of runaway inflation, soaring commodity prices, and supply chain snafus without having some kind of rain. Phil Orlando of Federated Hermes is still with us. So you were talking about how you would agree with that. We were talking about margin pressures and how that's not fully priced in earlier. Do you still think that the U.S. is the best place, or do you think that the U.S. is going to experience more significant unexpected margin pressures than other areas that have been more beaten up?
No, I think we're certainly looking at U.S. margin pressures based upon increased wage costs, commodity costs, transportation costs. That's going to manifest itself in I think, difficult second quarter earnings, and we're likely to see some guidance down from some company managements for the back half of this year. Now, international, to some degree, has priced some of this in. International stocks right now are about 40% cheaper than domestic stocks. So if you've got I guess a long enough time horizon, and if you can sort of look through the energy problems that the UK and the Eurozone are having with regard to oil and natural gas coming out of Russia, then the valuations in Europe right now are relatively attractive. But I think the margin pressure story is not a U.S. story specifically. I mean, it's one that we're seeing globally. Everyone is having the same problems.
Are there particular industries, Phil, that you're seeing more likely to come under margin pressures that are not priced in sufficiently yet?
You know, I'll give the example of Target, the big retailer, that's profit warned twice over the course of the last couple of months. And they talked about slowing economic growth, slowing margins, inventory problems. You know, they took our estimates down. And the pushback that we've been getting from clients, Lisa, is that, well, it's Target, it's a one-off. And our argument has been, no, Target's a really well-managed company. It's probably not a one-off. They're probably the only company, or one of the few companies, that has either figured out the problem, number one, or number two, is brave enough to come forward, you know, when they did, to talk about some of the issues. I think that virtually every company in America is going to be experiencing the same problems in the second quarter, and we're not going to get that final report card until they start reporting from the middle of July into the middle of August. So given the fact that you've got an 88% year-on-year comparison in the second quarter of 21 versus the second quarter of 20, I think the second quarter profit season coming up over the next couple of weeks is going to be very difficult. Yeah. And you know, given this dead cat bounce we're seeing this week, I'm not sure investors are looking that far ahead.
And perhaps not individual stock analysts either. And it's a question because we saw Patrick Palfrey over at Credit Suisse really highlighting how the fundamentals have not had a confirmation of some of the skepticism of the earnings season, saying, quote, people are calling for a decline in earnings, but we're not seeing it. They're interpreting the sell-off in the marketplace as a foreshadowing of an economic and corporate profit crisis, but we're not seeing it in the fundamental data. Phil, who do you think is wrong? The individual analysts who are actually looking at balance sheets and that perhaps they just don't have the visibility, or markets that perhaps have priced in a widespread earnings compression that perhaps may be more nuanced?
Look, I think the work that John Golub and Patrick do over at Credit Suisse is exceptionally strong. They do a terrific job. I think managements are going to have a come to Jesus moment a month from now and provide us, the Wall Street, with the sort of guidance that we're looking for in terms of visibility. We don't have a lot of visibility right now. And the markets, I think, were correct up until about a week ago. But as you pointed out, we've got this very strong counter trend rally here over the last week. That's fine. We were oversold a week ago. The market could rally for another week or two. But I think when we start to get some hard data and some hard guidance starting in the middle of July, I think the market will sort of retrace where we were, get back to that 3,800 level, and possibly plumb lower down to that 3,500 level as the market, the street, has some better data and can price that in.
Phil Orlando of Federated Hermes, thank you so much for being with us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, we are seeing a rally to end the week. The rally extending out quite significantly, with the Nasdaq up 2.1%, the S&P up 1.5%, 38.52. And you can see bonds getting sold off just a bit, but a real calm and constructive tone to end the week. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Markets at the open, a strong rally to end the week, at least if this holds. We've got a 2% rally in the Nasdaq, a 1.5% gain on the S&P, possibly the first week of gains in 4 weeks. Time now for the trading diary, what you need to be watching for the next week. The University of Michigan Consumer Sentiment Survey coming at the top of the hour. President Biden traveling to Germany for the G7 summit on Saturday. The president then heading to Spain on Tuesday for the NATO summit. Plus, Fed speak from President Mary Daly. And finally, central banking heads, including Powell, Lagarde, and Bailey, gathering in Sintra, Portugal on Wednesday. This was a countdown to the open from New York. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day this Friday, June 24th. Here are the top market stories we're following for you at this hour. Green on the screen. Stocks headed for its first positive week of returns after almost a month of declines. Meanwhile, bonds, well, they're catching a bid too. How much of this is simply an overdue reversal? Oil CEOs, they're getting an olive branch. Top refining executives meeting with Energy Secretary Jennifer Granholm yesterday on high gasoline prices. We're going to talk about what this means for Americans at the pump as we drive closer and closer towards the July 4th holiday weekend. And Boris Johnson, well, he's under pressure again. The chairman of Boris Johnson's ruling Conservatives resigns after the party lost 2 key parliamentary seats in just one night, raising fresh concerns about Johnson's leadership and his popularity. From New York, I'm Kriti Gupta in for Alex Steele with Guy Johnson in London. Welcome to Bloomberg Markets. Guy, it kind of seems like perhaps a little bit more calm in the markets, but there's a lot of news outside of the markets to be paying attention to.
To be fair, there's a lot of news inside the markets. We're just getting some of the data breaking right now, which I think is worth paying attention to, both on the home sales front, but also I can't remember the last time a final number from UMIDge was this hotly anticipated. Kriti, let me just walk you through the numbers. The headline number, actually a little softer, coming through at 50 on the nose. The prior number, 50.2. Current conditions, 53.8. So that's softening up as well. In terms of the biggest change maybe I'm seeing here is in the one-year inflation expectations, which is 5.4 down to 5.3. So broadly, actually, inflation coming down, but consumer confidence softening up. And then you've got a new home sales number, Kriti, which actually looks pretty good. What are you seeing there?
It does look pretty good. 696,000. The surveyed estimate was just 590,000. Compare that to the prior number that we saw, actually revised upward to 629,000. Really, what you need to know here is that those new home sales, well, it really speaks to the strength really in the housing market. Is that a bubble, though, remains to be seen. Remember, we are still dealing with this record demand for housing as we see perhaps more and more people move out of these city urban centers, choose not to rent because of those soaring prices, and instead choose to buy. Remember, still taking advantage of those mortgage rates, which are expected to go higher and higher. But for now, at least for today's data, it looks like a surprise to the upside, Guy.
Be interesting to see how much higher they can go without actually breaking something. Okay, let's break down all of this data. Let's figure out exactly what's happening here. The Michigan number clearly front and center. It's become a pivotal point in the market's calendar. Joanne Shu, director of the University of Michigan Survey of Consumers, joining us now. Joanne, thanks for taking the time.